That's going to be one of the questions this week.
Yeah. Earlier it said the big event is the Fed meeting on your graphic, but
Yes.
Is it a bigger event than getting the CPI number?
It's a big event, yes, because we get the projections for rates for next year, which is going to be new and updated from their September thinking. We're going to get the tone from Powell. He sets the tone. Is he going to talk tough and try to reverse some of the looser financial conditions we've been seeing? So I think it's important because he will also be able to react to CPI.
Right.
Which
Although
is why
if we get a hot CPI
important.
number, the market is going to react to that.
It's not going to like that.
No.
And the Fed might react to it, too. That's the thing. We got lower unemployment than expected. Right, 3.7% was a surprisingly good number. Wages were going strong. And then a firmer CPI could lead the Fed to talk a little bit tougher. That's one of the big risks this week, for sure.
Fed meeting does come as the Dow and the S&P come off these fresh 52-week highs. NASDAQ highest level since April of 22. All three major averages with this 6-week win streak. Joining us on the Newsline today, Wharton School of Professor of Finance, Jeremy Siegel's with us. Professor, it's great to talk to you. I was struck by the, nope, that's not the professor, but we'll get to that in a second. This journal piece over the weekend saying the Fed can't put off prepping for rate cuts because if you got productivity at 4 and productivity at 2, wages at 4, that kind of puts you near target.
Yeah. Absolutely. And, I heard Roger Ferguson, who I respect a lot, on the 6 o'clock hour, and he said, that could be a problem, 4% wages. But 4% wages is absolutely not a problem when you have 2-3%. And actually, you had over 5% productivity growth there in the third quarter. So, yeah, the unit labor costs have been going down. So that should not be a problem for the Fed, and I absolutely do advocate that they start thinking about lowering it. I don't think they're going to do it on January 31st, certainly, but they should think about uninverting the yield curve in their March meeting.
Why do you think? To what degree are the market's jitters about either a warm CPI or pushback from Powell? Are they justified to any degree this week?
Yeah, honestly, I think the dot plots are going to be hawkish. And I don't think they're going to be right. I think they're going to be too hawkish as developments do, but that could unsettle the market. Yeah, we will have to see CPI and PPI. Now, by the way, they've already submitted their dot plot, so nothing that happens tomorrow, Wednesday, going to change the dot plot. They are not going to move. That's not going to change either. But you were right in talking, a while back. It definitely would change the tone of the news conference on Wednesday that Powell does, depending on what those two factors are. And by the way, he has cover. The fact that the unemployment rate moved away from that 4%, which I think would have been politically not a good thing, down to 3.7, gives him more political cover in a way to be hawkish because unemployment is still under that 4% level, which is, quote, politically acceptable.
Speaking of politics, I've heard in a lot of, cocktail conversations, well, Powell's going to cut rates more and he's going to do it faster next year because he doesn't want Trump to get elected again. I know that the Fed is very apolitical. They would never do anything like that. But there is an election and an election economy to be considerate of, whether you're going to tie it to Fed policy or not. And I do wonder how that's going to impact the markets next year.
Sarah, you're absolutely. The Fed is a creature of Congress. It was created by the Federal Reserve Act. Congress can take away any of the powers of the Fed it wants to. And they got to be conscious. And truth be known, don't forget they still have a dual mandate. It's not just inflation. It is inflation and employment. So it isn't like he's abdicating all his responsibilities. And when we take a look at commodity prices, as you mentioned earlier, going down, yes, there's going to be some stubborn parts of inflation and core inflation that are going to continue. But, if you'd ask the American public, what would you rather have, 1% less on the core over the next year or another 500,000 people unemployed? I think the choice is clear, and I think he has to recognize what that choice is.
So you think the market, which is now expecting 100 basis points of cuts, no matter what the Fed forecasts in its dot plot this week, is more correct?
Well, take a look. 12 weeks ago in September, a majority of the FOMC said we're going to have another raise by December, by this week. and now that was wrong. And that was just 3 months ago. So, we're all going to take a look and shudder at, oh, my God, they're only predicting 2 cuts or 1 cut or 3 cuts. But the truth of the matter is, do you think they're going to get it right over 12 months when they got it so wrong over the last 3 months?
I want to talk to you about something away from the markets, but since you're at Wharton, the Liz McGill resignation, the Penn president, which developed over the weekend, I'm curious what your reaction is to it, as well as the chair of the board stepping down. Yeah. I really, I was very upset by the response. I think everyone was. I mean, it was more than tone deaf. She was given several chances to say genocide is unacceptable and not in context. And, when you say that, I see no way to survive. You have to go on. I'm not going to speak to Harvard. I'm not at Harvard or MIT. But it is a problem that has been encroaching the good elite universities for a long time, and I think they've been called on it. You think something deeper is broken? I mean, it's a step to see her resigning, but I'm curious from your perspective how pervasive this problem is. Yeah,
I think the problem has gotten a lot worse over the last 5-10 years. There is certain speech that's politically acceptable, other speech that is not, and they don't. You have to have a consistent policy on it, and maybe this will jolt the universities back into what they should have always been doing. I hope so. In any case,
Professor Siegel, it's David. Do you see a change in the classroom? Do you? Think twice before you say certain things, or no?
I retired from active teaching 2 years ago, so I still do special programs at Penn. But I have not seen any change in the classroom. And particularly, Wharton was not as affected as the other parts of the university in terms of what you could say, what you could not say. I always felt it was a little bit freer than perhaps other divisions of the university.
Professor, appreciate you entertaining those questions with a thoughtful response. Definitely a big topic of discussion over the weekend. We'll talk soon. Jeremy Siegel.
Absolutely. Thank you.
As we had to break, our roadmap for the rest of the hour. Yields pushing back higher today, what the bond market is expecting from the Fed, inflation, and rates.
Plus, Big Pharma's fight against fraud, the big money that's involved, and who's at risk. Got some details this hour.
And after the break, an exclusive that you're not going to want to miss. Delta CEO Ed Bastian will join us live from the Hope Global Forum in Atlanta. We have a lot more Squawk on the Street for you straight ahead.
Welcome back to Squawk on the Street. Let's get to Frank Holland this morning at the Hope Global Forum in Atlanta with a very special guest this hour. Morning, Frank.
Hey, good morning to you, Carl. That's absolutely right. We're here at the Hope Global Forum, the annual event for Operation Hope, a big event for financial literacy and financial wellness. And I'm joined by Delta CEO Ed Bastian, who's here to take part. You're going to be doing a panel in just a short time with John Hope Bryant to talk about Delta's programs. Thank you so much for being here with us.
Oh, great to be with you, Frank, and thank you for your support to Operation Hope. It means a lot.
I want to talk about your support for Operation Hope and also what you're doing to support your employees. You're launching a new financial wellness program for your employees where employees can actually be given. They can earn $1,000 if they go through one financial wellness track. Explain what you're doing and why you decided to do it.
Well, one of the things that we learned about the world during the pandemic is our focus on wellness was never more important, and we want to make certain as we're coming out of the pandemic that we're taking the very best care, not just of our employees' physical health, their emotional well-being, their social well-being, and of course their financial security. And the issues around financial insecurity kind of sit at the foundation of a lot of other issues as well. And there were a couple of stats that are prevalent out there in terms of the lack of Americans who have the ability to handle a financial emergency. 1 in 4 Americans do not have any capability to handle any kind of emergency on a financial standpoint. And over 57% of Americans do not have $1,000 that they could put their hands on in the time of an emergency at this point in time. And when I saw those stats a couple of years ago, I talked to John and we said, we need to do something about this. I want to make certain that none of our 100,000 employees at Delta are in that condition. And so we've instituted this wellness, financial wellness program that we're going to be unveiling the first year results that we've seen. We launched at the beginning of the year. We've had over 30,000 of our people have signed up for it. If you sign up, you take the financial training for financial literacy, you sign up and you finish a track with a coach, you get $1,000 put in your name, no strings attached, to handle any financial emergency that you want. And over 20,000 of our people have already concluded that.
So Delta, obviously part of Operation Hope's Financial Literacy for All program, and you're a proud member of that. I want to talk about your business now. We're in the holiday season right now. Give us a sense. What are you seeing when it comes to holiday travel? What are you expecting as we get closer to the end of the year where obviously we have Christmas and a lot of New Year's travel?
Well, as many people that were traveling during the Thanksgiving break saw, that people are continuing to travel and the demand for travel keeps strong. We saw more travelers during this Thanksgiving break than we've seen in our history, not just Thanksgiving, for any week of holiday peak travel. We broke the TSA pre-COVID level marks. The operational performance of the airline was amazing. For the 10-day period around the holiday, we had 50,000 operations that we launched. We had less than 20 cancels, over 90% on-time arrival, and that demand has kind of now getting us set for a Christmas break that I think is going to be equally as strong.
You also recently reaffirmed your full-year guidance. One part of reaffirming the guidance was talking about business travel. What do you see? What are you seeing when it comes to business travel? Of course, we had the pandemic where it ground nearly to a halt, and we've also had the rise of hybrid work and Zoom and things like that. As we look into 2024, what's the state of business travel?
Well, managed business travel, which is the traditional business travel, continues to improve. And post the Thanksgiving break, we saw another step up, maybe another incremental 5%. So the volumes continue to work their way back. We're probably somewhere about 20% below where we were pre-COVID levels on managed business. But the thing that people miss is that while people aren't traveling for managed business, they're traveling on their own at a much higher level because mobility has been at a premium because of hybrid opportunities to travel and work and bring your office with you. So in aggregate, my view is business is far above anything we ever saw pre-COVID. We're just managing and looking at it differently today.
Let's also talk about international travel, a higher margin business for you. Over recent weeks, we've seen a lot of geopolitical tensions, whether it's the Israel-Hamas war or other issues around the world. How is that impacting your international travel business?
Well, international had a great year. And I think coming up in 24, it's going to have another strong year. People had 3 years to plan their trips. And when they finally got the green light this year to go internationally, felt comfortable going, they went. Of course, we're watching what's going on with Ukraine, watching what's going on in the Middle East, and the challenges that presents. People are relatively resilient, though, in terms of travelers. And so we're watching with a cautionary eye. We don't see any pullback.
All right, before we let you go, I do have to ask you about one thing. This is actually a personal question. Sky Miles.
Yeah.
A lot of changes. You made changes, then you kind of changed them back. What kind of response are you getting for your Sky Miles program? What feedback are you getting for your customers?
Well, we made changes and then we modified the changes, and I think we're in a pretty good spot now. We have more premium customers than any airline in the world, and we've seen such a continued demand for our product that's outstripped our capability to serve effectively. And if everyone is in line standing into the Sky Club, that means no one is effectively a premium. So we needed to make changes. I hated making some of those changes.
Are you done, though?
We're done.
You're
We're
done.
done. We're
This
done.
is going to be it from now on.
This is going to be it for as long as I can tell. And we'll monitor it. And I think what we wanted to do is we wanted to enable our premium customers to have a premium experience on Delta, and that's our goal. We're continuing to build more clubs coming, more premium seats coming, more premium lines for travelers to call into. But until we could get caught up on the supply side, we had to do something on the demand side.
I think a lot of people want their status at Bastion. Those changes, very interesting. Carl, everybody back in the studio, tossing it back over to you.
And I will take it, Frank. Thank you. And thanks to Ed Bastian as well. Let's go to a quick break here, but check out the biggest laggards thus far this morning. And what do we have? Almost an hour of trading. Meta leading that. Of course, you can see Paramount as well, giving up a bit of the gains that it saw on Friday on those stories about conversations that we talked about this morning as well. Yes, they are conversing. No offers have been made. Next year, certainly early in the year, will seem to be crucial for the future of that company. We're back right after this.
Welcome back to Squawk on the Street. I'm Dominic Chu. It's a relatively quiet start for the week for stocks, with the S&P just wavering between positive and negative territory so far this morning. We are taking a closer look, though, at the energy sector on the heels of another big M&A deal in that sector. The Occidental Petroleum is buying privately held Crown Rock, which operates in that West Texas Permian Basin. The deal is worth roughly $12 billion on a total enterprise basis and will be largely financed through debt and common stock. It will add about 170,000 barrels of oil production per day to Occidental. Now, Occidental is also hiking its quarterly dividend to 22 cents a share from 18 cents beginning next year. Shares of Occidental right now higher this morning, just by about 1% or so. Elsewhere in energy, natural gas producers are under pressure. That includes names like Williams Companies, also EQT, ONEOK, Target Resources, producers, pipeline operators. Those moves come as natural gas hits their lowest level since June. And oil prices are slightly lower this morning after being both WTI and Brent posted their 7th weekly decline. Right now, West Texas Intermediate trading just below $71 a barrel and Brent just under 76 bucks. So keep an eye on those oil and gas prices and those respective stocks, Carl. Now I will send it back downtown to you folks at the New York Stock Exchange.
All right, Don, thanks very much. Still to come this morning, stocks are riding that 6-week win as investors now turn their attention to CPI, the Fed. In the week ahead, J.P. Morgan Asset Management's head of fixed income strategy will talk about where he sees yields going from here in a moment.
Welcome back. I'm Silvana Hanau with your CNBC News Update. Rudy Giuliani will be on trial today in a Georgia defamation case involving 2 former election workers. He was already found liable for defaming them when he said they committed fraud in the 2020 election. Now the jury will determine how much Giuliani will have to pay the workers in punitive damages. Their attorneys say they are seeking anywhere from $15 to $43 million. The Supreme Court won't hear a challenge to Washington state's ban on conversion therapy for people 18 and under. The law basically makes programs trying to change a minor's sexual orientation or gender identity illegal. A licensed family counselor in the state claimed it violated his free speech and religious rights. And summer blockbusters Barbie and Oppenheimer are leading the nominations for the Golden Globe Awards. Barbie nabbed 9 nominations, and the nuclear bomb drama Oppenheimer brought in 8. Meanwhile, Succession led on the TV side with 9. The award ceremony is set to take place in Los Angeles on January 7th. Carl.
Silvana, thanks. Got some breaking news this morning from Washington. Let's get to Emily Wilkins with that. Hey, Emily.
Congressional panel has been served subpoenas to Vanguard and Arjuna Capital for documents relating to an investigation on whether efforts to collaborate on environmental, social, and governmental priorities is a violation of antitrust law. The subpoenas for information are part of a wider investigation from the House Judiciary Committee, which is headed up by Republican Jim Jordan. In letters that Vanguard sent to Vanguard this morning with the subpoena, Jordan wrote that Vanguard, quote, appears to have entered into collusive agreements to decarbonize its assets under management and reduce emissions to net zero in ways that may violate U.S. antitrust law. Now, a similar letter was sent to Arjuna Capital as well. Both groups have provided the committee with some documentation in previous months, but Jordan said in the letter that he believes documents the committee requested are still missing. In the past year, Jordan has subpoenaed several organizations, including Glasgow Financial Alliance for Net Zero, as well as sustainability nonprofits Curtis and As You Sow. He's also requested information from asset manager giants BlackRock and State Street related to this investigation into antitrust and ESG, although neither of those companies have gotten a subpoena yet. And we'll see exactly where this investigation goes. It does seem headed into the next year where Republicans will continue to control the House. Back to you guys.
Emily, can you explain what is at the heart of this antitrust allegation when it comes to the ESG, I guess, policy and or focus of these asset managers?
So part of it is that a lot of these asset managers have gotten together in various groups with goals to really be able to reduce carbon emissions. And what Jordan's making the case for is saying, look, these groups get together, they try and implement these policies, but this is hurting sectors like oil and gas, and that how they're acting might be in a way that violates some of these antitrust laws. And so that's kind of where this investigation entirely circles around. There have been some other cases made. Certainly, House Republicans are not the only ones that have tried to equate ESG pushes with antitrust. But we'll see exactly where this goes, Carl, as far as whether they are really able to make that case.
All right, certainly taking a stand, at least. Thank you very much, Emily Wilkins in Washington. A make-or-break week when it comes to rates, yields, and the Fed. With the Dow and the S&P hovering at fresh 52-week highs, the Nasdaq trading at highs we last saw in 2022. JP Morgan Asset Management Global Head of Fixed Income Strategy, Bob Michel, joins us here at Post 9. Is the Fed going to mess this up, Bob?
I don't think so. I think they want to go out of this year fairly balanced. They don't want to be too dovish and create too loose financial conditions, but they also don't want to be too hawkish and create too much downside here. So they're going to try to thread the needle.
That was the message we got from Powell before the blackout period, right? That there are risks to doing, the risks are more balanced to over-tightening or under-tightening. He said that there are lags and that we haven't felt the full effect of monetary policy tightening. So you expect a similar message, sort of benign?
Yeah.
Would that be a green light to keep buying everything, bonds and stocks?
Well, look, the long and variable lags are always questionable when they'll hit. What we do know is that we're in nirvana right now. This is as good a soft landing as the Fed could have taken us into. So I, for one, am going to enjoy it. If bonds back up in yield, I'm out there buying. I think this could be a good week for this. You get CPI, you get auctions, you get the Fed. Maybe we'll be able to buy bonds a bit cheaper.
So you're not worried about any of those event risks as far as the disruption to the bond rally? Auctions, CPI.
I actually want a little bit disruption, maybe get the 10-year towards 4.5 to allow a lot of investors to get in. We talked to a lot of investors, institutional and retail. They're all trying to get into this bond market. Of course, everyone wants to buy at a higher yield. It came and went in October so quickly. Now we've got a lot of clients that are trying to chase this.
How long does nirvana keep up for, and what, in your opinion, is going to disturb that? Or most likely to disturb it, I should say.
Well, I do think that there is a rate shock that's been delivered to the system, right? We've had over 500 basis points of rate hikes. It's left things in a very vulnerable position. We're seeing housing has cooled off pretty dramatically. We're looking at the consumer, which is the engine of the U.S. economy, and the bottom 4 quintiles of earners have already burned through most of their excess savings. So unless the Fed is able to find an opportunity to bring down rates over the next 6 months, I think the high level of real yields is what could create more damage going forward.
There was a lot of forensic work done on the jobs number from Friday. basically arguing that we owe much of this year's job creation to government, maybe some private education, healthcare, and leisure hospitality. Do you think that X those things, and I know they're big pillars, but that the job market has slowed to a crawl?
It has slowed, and also you had the returning strike workers. What we like to do is look at a 6-month annualized rate, and the 6-month annualized rate is about 130,000 job creations, which is much different than close to 200,000. And then we went back to 2017, 2019, try to get out of the shadow of COVID, and what we found is job creations were about 164,000. So in fact, the labor market is cooling off. You've still got wages running at about 4%. The Fed would like to see 3.5%. But all of this are sort of the elements of a soft landing.
Well, there are two ways that narrative breaks, I guess, on the risk side. Either inflation spikes back up or flares back up, or the economy weakens worse than expected. Negative payrolls or a few negative retail sales prints. Which do you think is a bigger risk at this point?
Well, of those tail risks, I think to the downside, and I think the
on the economy.
On the economy, for sure. And I think what's kind of slipped through the cracks here is quantitative tightening. And the Fed continues to draw down its balance sheet. Of course, when they were expanding their balance sheet and creating money, it got into everything and inflated the price of everything. You would expect that you would see more disinflation and deflation coming as they draw down the balance sheet, and a good starting point is asset prices.
Yeah, I mean, I hear two versions of this one, where one, the trend is going down, it should hurt more in terms of asset prices and the economy. On the other, the balance sheet is still a few $1 trillion, very historically high levels.
Yeah, we looked at the level of GDP in nominal dollars, and headed into COVID, the U.S. was running at $22 trillion. Today, it's at $27 trillion. That $5 trillion is where we should have been 4 years from now. So that's how much was thrown into the system. And of course, that's on a nominal basis in terms of dollars. All of that created higher price levels, and that's what the Fed is trying to bring out of the system.
Yeah.
It's still there. It's still sloshing around.
Right. Bob, thank you. Bob Michel, great to talk to you from JP Morgan Asset Management.
Coming up after the break, inside the world of counterfeit drugs and how pharmaceutical companies are fighting fraud across the nation. A special CNBC investigation is coming up next. Pharmaceutical companies are fighting fraud across the nation perpetrated by criminals who tamper with life-saving prescription drugs. Who's in on it? Patients, pharmacies, wholesale distributors. In just one sophisticated scheme, hundreds of millions of dollars were stolen to siphon off profits from Big Pharma and stick taxpayers with the bill. Here's Contessa Brewer with a CNBC investigation, Fraud in a Bottle.
At the casino cage, wads of cash in hand. The security camera captures a real player, a larger-than-life gambler. With posts from luxury boats and private planes, Lázaro Hernandez fashioned himself as a high-flying high roller. Turns out, he was the mastermind of a $230 million drug counterfeiting operation. These thousands of bottles were all originally prescribed and filled for patients. Now they fill an evidence room at Gilead Sciences in Northern California. Every single bottle was discovered in a complex criminal drug diversion scheme.
We are playing a bit of a game of whack-a-mole.
Lori Mayall fights to find the counterfeits every day. She oversees global product security at Gilead, which manufactures HIV medications, Biktarvy and Descovy, drugs at the center of Hernandez's fraud.
We know that upward to 80,000 of bottles of counterfeits were entered into the supply chain.
And what would those be worth if someone was paying full retail price?
Those bottles would be about $230 million.
Here's how drug diversion works. A patient fills a prescription for a medication worth several $1,000s, but turns around and sells it for a fraction of that in cash. The buyer, known as an aggregator, removes the patient information, alters the bottle, then sells it to a wholesale distributor, who sells it back to the pharmacy at a discount. So the same bottle re-enters the supply chain. This bottle doesn't even contain pills, just rocks.
All they need to do is make the sale, and that's what they care about.
And this man, let's call him Julio, who agreed to an interview if we concealed his identity, said it was easy to persuade patients to sell their bottles.
They have AIDS, cancer, and they don't have any money. So for $100, $200, they'll sell it every day.
So they'll forego the medication. They won't take the medication.
They won't take the medication.
The fraud achieves size and national scale because licensed distributors buy from aggregators like Julio, sell to the pharmacies, and give the whole process the sheen of legitimacy.
They're a critical cog in the scheme.
And the distributors have relationships with thousands of independent pharmacies across the nation. Stephen Mahmoud is Assistant Special Agent in charge at Health and Human Services Office of Inspector General.
The pharmacies that are on the receiving end of these diverted prescriptions, do they know?
Some do, some don't. Medicare pays out to pharmacies a lot of money for these drugs because they are expensive and life-sustaining.
This hidden camera video has never been seen in public. Shot by an undercover informant, it shows a woman, her husband and son, cleaning prescription pill bottles in a South Florida apartment.
The individual in the white shirt in the middle, you can see the what appears to be lighter fluid. He's using that lighter fluid, a harsh chemical, to clean the bottle and remove the pharmacy prescription label.
Gilead Sciences and Johnson & Johnson have sued distributors and pharmacies throughout the country. Their investigations and litigation are still unfolding. These three were convicted in connection with a prescription drug counterfeiting operation. Lázaro Hernandez's jet-setting days ended abruptly this year. He was convicted in that $230 million drug counterfeiting operation. He pled guilty to conspiracy charges related to distributing adulterated and misbranded drugs and money laundering. He is serving a 15-year prison sentence.
And you know who has largely escaped any kind of responsibility here? The wholesale distributors. None have been criminally charged, though the CEO of Scripps Wholesale, based in Brooklyn, was indicted in June for buying more than $150 million worth of prescription HIV medication, which had been illegally diverted. Prosecutors say he then turned around and resold it to pharmacies. He's pled not guilty, and his attorney declined to comment to CNBC.
What are the sentencing guidelines, and is there an effort to toughen them up?
Well, they are definitely trying to go after the linchpin here, because you can have all of, like, for instance, Julio, who we interviewed in our story. He was convicted in this scheme. He says he's gone clean. Those days are behind him, but he served time behind bars. He's the aggregator, right? He's going out and offering people $100 or $200 on the street. But if you have the big distributors who are licensed to sell these medications, lots of them, it muddies the water a little bit. And also, you can't send a company to jail, right? You can send the boss, you send the CEO to prison, but they really are the linchpin here. And the investigations so far have not been able to thoroughly bust the distribution process.
Can the drug makers do a better job at I don't know, tracking their own pills? Like putting something in them to track them through the supply chain?
I had asked about even RFID, and they said that the process by which you could have one bottle be tracked thoroughly is in the process. But they have paperwork that's supposed to go with every shipment, that you're supposed to see that it comes from Gilead, it goes to a licensed distributor, and then to the pharmacy. But what's happening is even the paperwork gets counterfeited, it gets made up, and the documentation isn't valid.
So to be clear, the original patients are covered by insurance, so that's why they're incented to potentially sell, right?
Or Medicare.
Or Medicare, right. Well, some sort of, right.
Right.
And so they're getting paid cash. But you had rocks in one bottle, but are oftentimes the actual pills still in the bottle?
Sometimes it is actually the medication that has been prescribed, but then the labels have been messed with, or the patient literature is fake, or what they call counterfeit. Anything that falls under this tampered with gets called counterfeit. The interesting thing is they even found, and this is what alerted Gilead in the first place, they got alerted by hospitals, hey, we had people who were supposed to be on HIV medication, and they were on medication for bipolar disorder and had a bad reaction. Now, why you would replace Seroquel or Biktarvy with Seroquel doesn't make sense to me. Doesn't make sense to me why you would put rocks in the bottle. Sometimes, though, the aggregators are only buying the bottles. They'll go in and say to somebody, hey, I'll take your empty bottle and I'll pay you $30 for it, and then just fill it with something to put it back into the system.
Right.
Well, then now you're talking about something that can be truly dangerous and life-threatening.
Absolutely. Yeah. The one thing, my big takeaway from this for everybody, because even in a legitimate pharmacy with legitimate drugs, mistakes happen. So when you get a prescription, it's always smart to go through and double check online, is the pill that I'm about to take actually what's been prescribed?
Because there is a stamp,
yes,
right? And they are numbered.
That's right.
But how widespread is this, really?
Well, hundreds of millions of dollars, and that's just by Gilead and Johnson & Johnson and others. And you've got Health and Human Services and the FDA looking into other kinds of counterfeit. And now, Sarah, they're looking at, for instance, Ozempic, which is so in demand right now and so easily counterfeited. And people just, what? I can get it at a discount? Let's go for it. Buyer beware.
That's a good investigation. Good findings on your part. Contessa, thank you very much for sharing. Still to come, Netflix betting big on live sports, but will it pay off? With shares up more than 50% since January, we're going to discuss that next.
asset.com.
Take a look at shares of Shake Shack. They're soaring this morning. Longtime CEO Randy Garutti, who oversaw the company's IPO, is retiring next year. Garutti will remain with the company in an advisory role through next year. Shake Shack is saying that Korn Ferry, the HR firm, is leading the company's search for a successor, along with a committee of board members that will be led by founder and chairman Danny Meyer. Danny Meyer will join us in the next hour, Squawk on the Street, of Money Movers, I should say, to talk about this transition, this change. Randy's been with the company, I think Danny hired him 24 years ago for Union Square Hospitality for one of his restaurants, and really helped Shake Shack get born and expand to what it is now. Hundreds of stores, took it public back in 2015, so it really is kind of a changing of the guard.
This is a nice gain, almost 9% for Shake Shack, going to take you back to early June as they reiterate, actually September, as they reiterate the guidance. And what's been a really interesting week for restaurants in general, given some of the McDonald's guidance last week and the willingness to step out and try to get some share, and especially in QSR.
Yeah, I think the takeaway from McDonald's was that they're thinking more aggressively about restaurant expansion. Right, they had some pretty aggressive growth targets for how many stores, how many loyalty members they want to create, the
automation,
focus on tech and automation.
New concepts.
Yeah, so markets seem to like that one as well.
Another story this morning is Netflix. It's leaning into live sports, announcing its next event this morning. It's going to be called the Netflix Slam. It's a special one-night tennis exhibition headlined by Rafael Nadal and Carlos Alcaraz. It'll be in Las Vegas in March. Netflix CEO Ted Sarandos hinted at more of these kind of events earlier this month at a UBS media conference, saying they'll be focusing on boosting the popularity of different leagues and players by leaning into the storytelling and drama of sports. Of course, a lot of that started, Sarah, with, I mean, I don't know necessarily this exhibition or what's at stake here for these two, but a lot of it started with
F1.
F1.
Well, they did this kind of crossover event in Las Vegas with F1 players and PGA players in a golf tournament that was live on Netflix. I think the results were okay. Of course, you can never tell because Netflix doesn't share audience numbers, but there wasn't any big mishap like they've had, I think, in the past with some live TV.
Yeah, I mean, the bigger question for companies such as Netflix and even more so Apple and Amazon when it comes to sports, Carl, is the bigger leagues. The NBA contract, for example, right now is sort of a focus of many in terms of who can afford what and how big will the streamers come to play in terms of Amazon, Apple, and or Netflix. Not really so much. They've been more focused on events like this.
It is interesting. All the things that for years they swore they would never do: gaming, password sharing, advertising, and live sports.
They're capitulating.
All four are in full display right now.
In a kind
amazing.
of Netflix way. I mean, I think the drama of it that they want to do, Drive to Survive, full swing. They do have shows behind.
Yeah, you got to be willing to change, just like we do with our graphics package.
Exactly, we evolve.
Real quickly on Endeavor, I did want to point to those shares. A significant decline. Again, the last hour on Endeavor, it's for sale. Silver Lake, the only buyer, of course, controlling the company as it does. But they haven't talked price. They haven't made an offer. There is not a special committee yet formed. They are doing their due diligence and also probably focused on raising the equity for said deal. Again, sources indicating an expected bid, if it comes, would probably be towards mid to late January. We'll keep an eye on this, but you can see those that stock has reversed. That does it for us right here on Squawk on the Street. We've got a lot more coming your way with Carl and Sarah after this.
S&P.
Good Monday morning. I'm Carl Quintanilla with Sarah Eisen live on the floor of the New York Stock Exchange. You might have noticed our screen looks a bit different today. Some information and data in different places than the last time you joined us. We do hope our new layout will make it easier to break down the news that does matter most for your money.
That's not the only change on your screen. This hour is now the home of Money Movers, and your home for the biggest names on Wall Street to the agenda setters in Washington. Let's get to it ahead this hour. A shakeup at Shake Shack CEO Randy Garutti retiring next year. The hunt for his replacement underway. He's going to join us, along with the Shake Shack founder and chairman, famed restaurateur Danny Meyer.
Plus, time for window shopping is over. RBC says to become a buyer of Pinterest. We're going to break down that call.
And then a number of M&A headlines to get to, including Macy's. The retail sector seeing a nice bump off that this morning.
First, though, take a look at the markets here. Dow's up 105. 4611 is going to be not just a high for the year, but well above the intraday high that we got during the summer. Meantime, getting some breaking news out of the New York Fed. For that, we'll turn to our senior economics reporter, Steve Leisman. Hey, Steve.
Hey, Carl and Sarah. The New York Fed reporting its consumer expectations, saying short-term inflation expectations fell in November, down by 0.2 percentage points to 3.4%. That's the lowest level for one-year inflation expectations that we've seen since April of 2021. The 3-year, however, unchanged at 3%. The 5-year unchanged at 2.7. Fed probably looks a little bit more at the 3 and the 5, but the market's been very fixated on these short-term expectations, especially after the December number came in from Michigan unexpectedly below 3% on Friday. In this survey, expectations fell for gas prices, food prices, rent prices, going way back to January 21, the lowest increase, as well as college costs. Expected earnings growth declined as well, and expectations for unemployment rate, the unemployment rate fell, but they rose for people's individual sense of concern about losing their jobs. Taking a look at the Fed rate cut probabilities, unchanged on this news, maybe a little bit, but pretty much unchanged at 39% for March, May 75%, cut probabilities in June 91%. Guys, that's down a bit from what we've seen in the past couple days, maybe as this meeting gets closer and people are concerned that Powell would push back. They're easing back on the expectations, at least for that certainty about the March rate cut.
It's good news for the Fed, Steve, to get the inflation expectations falling. Got that in the University of Michigan on Friday, right? They pay attention to that. They want to keep them anchored, even if it does have to do with the fact that gas prices have cooled off a bit. So what's going to be the discussion at the Fed around the table around whether they can get back to target fast enough with the market pricing in 100 basis points of cuts next year?
So let me take those two pieces one by one. The first is, yes, they're looking at the 1 year, but they also know, as you suggested, Sarah, the 1 year is linked very closely to oil prices. And they're still going to be concerned about those 3 and 5 years being up near 3%. They'd sure like to see those fall. I think the concern and the discussion at the Fed is going to be how not to talk about rate cuts prematurely. I'm not sure they're ready, but the market has priced it in. And I don't know that Powell this time around can completely avoid the question the way he did last time. He's going to have to respond, but I don't know that they're going to want to give the green light to say, yeah, you guys are right to be banking on rate cuts next year and early next year.
Steve, thanks. Steve Leisman, nice follow-up to the data on Friday. Let's stick with the Fed. When it comes to this week's meeting, our next guest is not expecting any change in messaging from the central bank, but she does say it's time to stop obsessing over recession fears and start finding some value in a few key themes to watch next year. Joining us here at Post 9, Morgan Stanley Private Wealth Managing Director Sherry Paul. Welcome to Money Movers. Good to have you. You're our first guest on the show of this name.
I love it.
Yes.
First mover of money.
Yeah, let's move it. Let's move some money and make it.
So what do you mean obsessing about recession fears?
Well, first of all, thank you for having me. What I'm talking about right now with investors is that we've got to break out of this mindset of living in arrears. And where did obsessing about recession get anyone last year other than poor returns? And so I'm really encouraging investors to move on from the Fed. The Fed is going to stick to their strategy. They haven't deviated. The Fed's strategy is to err on the side of inflation. And they'll continue that hedged language throughout the course of the week. But one massive thing that's changed is we've moved into a moment of innovation that cannot be denied, that is unending, the way that corporate profits will be delivered. And my personal belief is that we're going to see a profits reset, but we're within a cost-cutting bull market, and that's where investors should be focused.
So the one of the house views within Morgan Stanley is maybe a less than optimistic view of corporate profits. You're okay with that?
I'm okay
There are ways to work around that.
Yeah, because I'm a senior portfolio manager. My responsibility is to be investing client money and making money in all investing conditions. So yes, we're going to go into a year of more turbulence, more geopolitical turbulence. We've got a deglobalizing, reglobalizing world economy that is going to present a lot of people with a lot of anxiety, and structurally will change the way that businesses are doing business. But at the same time, we have this massive change we haven't seen in decades, which is generative AI, which will undend the labor market in many ways and create a tremendous cost saving for corporations. And remember, profit cycles don't care where they come from. Companies just need to make money. Sometimes they do it through expanding margins, and other times it's through cost cutting.
We were just showing a graphic of your picks. So healthcare and defensives, but also financials, which is kind of more cyclical. What's the thinking?
Well, the healthcare thinking right now is one of the only negative sectors year to date. So that's a pure value play, but it's also an innovation and vaccine play as well. And I think if you take a look at biotech in particular and the way that healthcare stocks will trade based on vaccine pipelines, and you dump some ChatGPT sort of innovated vaccine technologies, we could see a real move within healthcare.
Because it's been about obesity drugs, and if you're not there, you're not worth buying.
Right, I know. It's so ironic, right? How the cycle of vaccines and what human behavior will value within medicine over time is the industry in and of itself. But I'm really focusing, though, between healthcare within the subsector. You would definitely want to be in biotech and innovation technologies. But I would also encourage investors.
Just going to stop in here for a minute and highlight for you that you want to be seeing these previous highs get taken out here. PT2, PT3 had these left over from Friday. This one's still not quite tagged. I think these are exact for the previous highs from March of 2022. Just keep your eyes on this. You want to see if they can tag these. Just keep pinging them. There's one, then hopefully get the second one right here, and then look for some kind of a roll. Should be an important moment as after PT2, PT3. I don't know if I put it on this chart, but this is the stuff. This is the sauce here that we're looking for above. So if you check out these yellow lines right here, these are all the previous highs. This is actually a new band from January of 2022. So just like there's actually some down here. So after taking all of this stuff out down here, we are then going to focus on the highs that we left behind in early January 2022. These are the March highs of 2022. I got a real echo going on here, don't I? Check 1, 2.
Plays are going to matter a lot, and then distinguishing at the corporate level winners and losers. It's a stock picker's market in that respect. So mentally, my clients understand and see that, the complexity of it, but it's time value in the market that's going to win the day.
Part of Mike Wilson's note this morning is about the election next year and the uncertainty, not just around the process, but taxes and trade and so forth.
Sure.
Do you think that's going to be front of mind in the first half, or do we really wait till it's right in front of us?
You know, I hope not. I always really advise clients not to get too caught up in what I call policy volatility. I mean, I've been managing client portfolios since the late 90s. Lots of different elections, lots of different economic climates, lots of Fed cuts, lots of Fed rate hikes. And guess what? Look at the chart. Look at the chart on where the S&P is today. So I'm encouraging investors to sidestep that. However, that doesn't mean that you don't want to lose your strategic thinking, right? Time in the market is not an investment strategy. It's a philosophy. The strategy today for clients should be to overweight stocks, have short to intermediate bonds, and then favor sectors that are going to benefit from cost reduction innovation.
That was good. Sherry, thank you.
Thank you.
Good, thanks for being with us. Sherry Paul.
Thank you.
After the break, the CEO of Shake Shack announcing he's retiring from the company this coming year. He's been in the role since 2012 and led Shake Shack through its 2015 IPO, stock nearly tripling since then. He's going to join us, along with Shake Shack founder and chairman Danny Meyer. Money Movers continues after a short break.
Shares of Macy's surging this morning on rumors of a potential buyout as Arkhouse Management, Brigade Capital Management reportedly offered the legacy retailer $5.8 billion to take it private. Isn't the first time there's been some M&A or activist activity around Macy's. Starboard disclosed that stake back in 2015. Hudson's Bay tried to take over in 2017. And of course, Jana announced a position in 2021. This proposal values Macy's at $21 a share. 4 over its Friday close. Stock has struggled, still negative in the last year, even with today's move.
Real estate. They're sitting on a lot of billions of dollars worth of real estate. Could be part of the strategy here. Well, from retail to restaurants, let's talk Shake Shack. CEO Randy Garutti announcing he will be retiring in 2024 after the company finds a successor. Stock moves higher this morning. It's up more than 50% just this year. The company also reiterated guidance. Joining us now in an exclusive interview is Shake Shack CEO Randy Garutti and Union Square Hospitality Group founder and executive chairman Danny Meyer. Gentlemen, welcome. Good to have you.
Thanks, Sarah and Carl.
Good to be here.
So, Randy, why now?
We've been building this thing for 24 years. Danny took a shot on me when I was a young restaurant manager, and I don't think any of us ever dreamed from the little hot dog cart and fine dining company that Danny birthed that we'd be here. 500 shacks, 18 countries, and a world of leaders that built this thing. And it's time for me. It's just time. I've got the next season of my life dedicated to my family. My kids are getting older, and it's time to spend a little more time with them in this next season, and we're super excited about it.
I do want to talk about the future, but it is an amazing New York story, the birth of this company as a hot dog stand, which people think of it as a burger restaurant. Take us back, Danny.
Well, I'll take you back to 2001 when we were in the process of helping to restore Madison Square Park, and we thought that if we had art in the park, it would bring people to use the park. So we had a hot dog cart that was part of an art project. Just hot dogs, Chicago-style hot dogs. 100 people would wait in line every single day. And we said, we're just doing this to help the park. We didn't expect to have a business. We lost a few $1,000s each year for 3 years because most hot dog carts don't have 4 people working there the way we did. But all of a sudden in 2004, we said, let's turn it into a permanent kiosk. And we gifted this kiosk to Madison Square Park so it would become the landlord, so that a percentage of every sale would go back into the park. That's all we wanted to do, Sarah. And then
Here we
all of a sudden we had a public company 15 years after that.
I know. I love that story. So you're working with Korn Ferry.
Yep.
On finding a new CEO. What are you looking for? What's the next chapter for Shake Shack?
Well, Randy has done the most magnificent job of building not only a company, going from one Shake Shack to over 500 internationally, but the culture is really the secret sauce of Shake Shack. People don't necessarily talk about it enough, but the way it feels to work there, the way it feels to eat there, the way it feels when you get one in your community, we're going to look for a leader who prizes what Randy's done. He has said many times that we're in early innings with Shake Shack, and we're ready to hand the ball to someone who can take us into the next part of the game with a big lead, I might add.
What do later innings look like then? Is it about store count or menu or something else?
Carl, I think it's all the above. I mean, next year we're going to launch in Canada. We're going to launch in Malaysia. This brand has surprised us at every turn. We never dreamed we'd be here, and now here we are. We've got a firm grasp on who we are. And I think it's about tightening up what we do, doing it better, and making sure at the heart of it, it is our people. The number of people, I think what we're most proud of, who started in hourly positions and now have led regions of our company and gone far afield to do better. That's what's built this thing all along. And I think Shake Shack sits today, and our leadership team today is so well positioned to continue that growth and really start growing even more.
Danny's got a lot of disciples just in the realm of management and leadership and hospitality. And I know you mentioned your family, but is it not hard to walk away from other things you might have done for him, with him?
It's so hard. Danny has been my mentor, one of my best friends, and our leader. And I'll tell you what, after 24 years, not only can we finish each other's sentences, but what he taught me about leadership, all day, every day, we tell each other what's important to us. There's not a single thing that could ever happen at Shake Shack or in this company or for our people that we don't know that each other would say. We don't agree all the time. We've got a lot of disagreements.
Well, those must be fun to watch.
Oh, like the time he wanted to take Sundays off the menu. All I got was the piece of metal from the Shake Shack that says Sundays.
But it's been a journey that couldn't have happened under any other crazy circumstances. Some of our best decisions would be the one that a lot of smart people would have advised against in the early days. And those things like going to Dubai as our first international restaurants, we had less than 10 shacks. Going as far afield as we did. This brand somehow has punched so far above its weight. And even today, at 500 restaurants, people are always like, really? You have that many restaurants? I thought you guys were so much smaller. But this brand is so big.
But, it hasn't always been smooth sailing in the public markets, right? You took it public in 2015. It's well off the highs. There have been challenges like labor costs. You went through COVID. I mean, what do you think are some of the biggest challenges for your successor?
I think our brightest days are ahead when it comes to our public market and our valuation. If you really look at the ride since COVID, Shake Shack got really hit harder than most other companies given our urban and geographic footprint. And every day since, that trajectory has been straight up. You look at what we've done this year, how much the stock is up this year, our sales, we've improved our profitability and taken down the cost to build. And I think the successor will do what they think is right, but they have such a strong foundation. And if you really look at the momentum of the company, everything's headed in the right direction.
I think the right successor will look at the Shake Shack story and say, you guys already did the really hard work. You've got a company that is beloved by the people who work there, by the people who dine there. And now I can apply some of what I've learned, maybe in a much larger company, to what we've already done here.
How big can it get in terms of unit growth, Danny? Because that is why it gets a premium valuation, because there's great expectations there.
I don't think we actually know the answer to that just yet. When we went public in 2015, we laid down a chit that said 450. We've already run through that one. And I think that what we're seeing both domestically and internationally suggests quite a bit more.
I remember that day, and I remember one of the criticisms of the IPO was that operating leverage ex New York would be much different. Has that turned out to be remotely true?
I think we figured out a lot of new models, and including in the last couple of years, we launched our first ever drive-through. If you really look at what's ahead, this year we're going to open almost 80 Shake Shacks. 40 of those roughly our own company operated, and 40 in our international and licensed business. You said it earlier, Sarah, there's a few in JFK.
Yeah.
So we try to make people happy when you're traveling, and you have low expectations. We tend to win there. And
that
next year
that Delta terminal is long, and there's a Shake Shack every few
at least we think about 80 Shacks next year as well in a similar format. And I think, Carl, as you look at it, we found success across the country and in so many places around the globe. I wish so many of our viewers and fans could transport themselves to Hong Kong or London or Shanghai and see what Shake Shack looks like in those places. And you'd be amazed at the rabid fan base and the love of this brand that somehow has transcended borders over time.
Where does it not work? What kind of markets?
Very few places. We've never closed a restaurant here in this country except for Penn Station because we had to, and it's coming back next year. So we'll get you back for all of our Penn Station commuters. Look, it hasn't been easy in certain places where it's a little more geopolitically volatile. But generally, we serve the most mass appeal product in the world in a way where everyone says, yeah, I love a cheeseburger, but I want it to be better than traditional fast food. That's the place that we've filled. And that place is wide open for us to continue to grow.
It's an ingredient story, and I think you know that.
And an engineering story, I would imagine, right? Being able to do it in a reasonable amount of time.
I think you're absolutely right, because every burger is cooked to order. It's not fast food, as anyone who's been there will tell you.
So, Danny, how would you characterize beyond Shake Shack and then broader, because you operate this big restaurant empire, are you seeing any signs that demand is tapering off after the post-COVID surge?
No, this is the first holiday season post the pandemic that I would say that things are not only normal, but beyond normal. We've never seen a holiday season like this, and I'm talking about every single price point, whether it's a full-service fine dining restaurant, many of which you guys have gone to in New York City, or whether it's our catering company, Union Square Events, or whether it's a bar like Porch Light or Shake Shack. They're just posting great numbers, and whatever bad news people hear on TV or on the radio, something's making them say, well, I better eat out because I better get it now because I'm feeling pretty good.
Is pricing back to normal too in labor, because you dealt with all those challenges?
I think we're at a point right now where we're not talking about price hikes for the first time in a long time, and that feels great. None of us in this industry like to raise our prices. It just doesn't feel good.
On the labor front, Sarah, it's been
better.
This year has been some of the best retention and turnover numbers we've had ever in the history of Shake Shack. And it has been really hard the last 4 years. Really, really hard. And it's right now continues to get better. So we feel really good about that part of the business.
Leaving Shake Shack aside, this industry deserves to have some wind at its back, and hopefully 2024 will give us what we've all worked so hard for.
Well, you've been a good spokesperson for the industry throughout the ups and downs. Danny, thank you. Randy, congrats. Keep us posted on what's next. You're a young man, as we mentioned. Randy Garuti, Shake Shack CEO, and Danny Meyer, of course, Union Square Hospitality Group founder and executive chairman.
Thanks, guys. Still to come this hour, RBC ups Pinterest today, says the stock's a great way to play the ad market, chase some impulse shoppers. We're going to break down that call.
Plus, if you missed any of our money-moving interviews, you can check out our podcast. Follow and subscribe where you listen to your podcasts. We're back in just 2 minutes with the Dow up 86 points. European markets mixed this morning as investors hold their breath ahead of this week's Federal Reserve meeting and the potential impact on global interest rates. China's the big story abroad, though. Consumer prices falling at the steepest pace in 3 years, and producer costs also dipping into negative territory. This as Beijing struggles to boost domestic demand. Deflation fears are rising, and that's because the numbers have negative signs in front of them, very different than, say, U.S. and other developed markets. Inflation rates. I think the feeling is that China can do more to boost demand when it comes to fiscal stimulus. And we did just have this Politburo meeting last week where they did talk about, getting the economy back on track. Will they come up with a 5% growth rate again, target next year? The market is expecting that, and stocks rallied off this.
Also, a lot of discussion around the market for pork and how much that has not just influenced the data, down 30 plus year on year, but whether or not the Chinese consumer has changed their diet to the degree that that supply overhang is going to be with them for a while. Kind of interesting.
It has an outsized effect on CPI, but I think there's also a feeling that it was a little broader base, the numbers, and worse than expected today, and that the deflation is moving from goods to services, another potential worrisome sign for demand.
Meantime, Dow hanging on to a 100-point gain here. Let's get to Bob Pisani for a look at what's moving. Hey, Bob.
We've been in and out of positive territory on the S&P, but essentially we're at new highs, and we are doing this without the biggest stocks. The 7 biggest stocks in the S&P 500, all down, of course, all tech names, and some of the other big names. Some of the chip makers are kind of mixed today. Here's Taiwan Semi, one of the big foundry companies out there in the world, that's down fractionally. But what's interesting to see is the biggest names in the S&P are down, but some of the smaller tech names are still holding up very well. Some of the other semiconductor makers are doing well. Software companies like ServiceNow is doing well. Broadcom, Micron holding in there. I said the 7 biggest stocks, your Apples, Amazons, Alphabet, Nvidia, all down. The 8th biggest stock in the S&P 500 is Berkshire Hathaway. I don't know if I can put it up, but it's been moving up recently. I'd say it's slightly below the S&P. It's probably up 17 or 18% for the year, a little bit below the S&P 500. But financials have been doing great. Those regional banks have been really strong. PNC, Fifth Third have also been doing really well recently. Another group that's shown some real momentum besides financial is any of the kind of industrials. There's United Rental, been doing well. Fastenal's at a new high. Ingersoll Rand's at a new high. Packar's at a new high. Again, this is one of those groups slowly moving to the upside in the last month, particularly in the month of November. Not a lot of, action in the oil names, but with oil now over $70, Halliburton's finally bouncing. I mean, just a disastrous couple months. Halliburton's down 25% or so. It was $44, $45 2 or 3 months ago, and now it's bouncing a little bit, but so are the other big oil names that are out there. But generally, not been a great year for those oil names. And another group bouncing is the REITs, the Real Estate Investment Trust. There's a new high in Simon Property Group. Again, all these stocks have been moving as interest rates have been moving down in the month of November and well into December. So what we want now is a broadening out of the market. That's exactly what we're getting. The equal weight RSP has been outperforming the S&P 500 for the last month. That's the simplest way of indicating that the rally is broadening out. Again, guys, top 7 S&P 500 stocks, techs, all down today. Yet the S&P is up. That is a sign of a fairly broadening out rally. Guys, back to you.
All right, Bob, thank you. Well, we'll monitor that breath. Time now for a news update. Silvana Hanau has it for us. Hi, Silvana.
Hey, Sarah. Good morning to you. Israel released a list today of 20 Hamas hostages believed to have died in captivity. Pressure is mounting as families of the more than 100 remaining hostages push for their release. Israeli officials say their rescue remains a primary goal. Meanwhile, the military wing of Hamas said yesterday Israel won't be able to recover any hostages without an exchange agreement. U.S. and South Korean military officials say a U.S. Air Force pilot safely ejected from his F-16 fighter jet before it crashed into the sea off Korea's coast. According to a statement, the pilot took off from a jointly used airbase on a routine training flight and had to eject because of an unspecified in-flight emergency. And Ukrainian President Volodymyr Zelensky will address U.S. military officers today as part of a last-minute push for Congress to renew weapons funding for his country. President Biden is urging lawmakers to pass a $110 billion package that includes funding for Ukraine, Israel, and other national security priorities. But it's being held up right now over debate about immigration policy and border security, Carl.
Silvana, thanks. Coming up after the break, RBC is done window shopping on Pinterest. They say it's time to buy. We're going to break down that call after the break. Stay with us.
Crypto Watch is sponsored by Grayscale. Crypto investing begins with Grayscale.
Hey, what's going on out there? So I just saw RS say, can someone please explain to me how the Mag 7 are basically all negative, that the S&P has not dropped, SEC not involved? The reason is there's a large rotation into small and mid caps. So I think of the idea, we talked about this last week. So RS is asking a big question right here. So try to wrap your head around this, okay? When the Fed telegraphed that they would begin rate hikes, that they were going to begin rate hikes, you saw in late 2020 all spec growth began to get, hey, Will, what's going on? I got to go back to what I'm doing, but I got to answer this question because there's a thesis here that we discussed last week. So the idea would be this. If you remember back, if you've been trading for at least COVID, let's say, right? Spec growth boomed. It just boomed. And then what ended up happening was there was an under the surface cutting of small and mid caps when the Fed began to telegraph they were going to raise rates. And we had almost a quiet,
Big bull call out of Deutsche Bank this morning.
almost a quiet stock market crash behind the scenes. And to that point, you saw that like we went into like December of 2020. CNBC was out there saying, "Hey, buy ARK G, ARK this, ARK that. There's still more room to run," and the banks just sold into retailers. Now, any of the stocks that benefited from liquidity in the market, right? With the so like Apple's and all the big tech names, they all stayed up while almost like if you had a chair, they were cutting legs off underneath the market without the market crashing violently, right? So we saw a gentle. If you were watch the indexes, they were gently lowered in 2022. In 2022, 2021, there was a massacre of all of these small and mid caps, IWM too as well. So this was a front running of rate increases. As we cycled through those rate increases, they eventually came after the indexes and large cap stuff like that. So think of this stuff kind of cyclically. Now that there's an attempt to front run a pause in rates, if we do not get a rate increase, you'll never see another one. So the idea here would be you should see just like we saw the front running prior to rate hikes even beginning, the cutting of all the spec growth, a move into those tickers, a move into mid caps, small caps, anything that got clipped. You should be looking back, I guess, into what got clipped in late December of 2020 and then into the new year of 2021. A bunch of those tickers are going to come back to life. As a matter of fact, I was just looking at some tickers down in your bottom left-hand side of the screen that you're looking at this morning. We'll take a look at a few of those here right now. Hold on one second here. And let's take a look at, let me give you an example. So you see the Mag 7, whatever, right? All that Mag 7 stuff. And give me one quick second and see if I can show you this here. One quick second. So I took a quick look this morning. Let me see here. Weeble chart. Okay, this is a Weeble chart right here. I took a quick look this morning at some of those tickers. So let's take a look at DUOL. This is Duolingo. I'm going to look at this on a year chart. Take a look at a year chart here on Duolingo. Nice. Not a year like that. A one-day chart on a yearly basis. Hold on here. And so here's Duolingo, right? It's just monstering. We've been tracking this one for some time, right? And you're seeing this major rotation into Duolingo, and you're seeing it into a bunch of other tickers as well. And what the idea here is that this is going to, or the idea here is that where you have the front running of rate increases, destroying a bunch of companies or high risk companies, you're now seeing a rotation back into that. This is GitLab right here. And we've been talking about GitLab forever, right? You can see the same thing in GitLab here, right? They're putting risk on back into these tickers. I'm going to give you some others to look at. BR, ZE is another one. Braze we've talked about in the past. Same thing, right? See, that's big swing down over here. And now they're front loading from the back end over this way. So we've already brought these tickers up. We've already known that this was anticipated to be coming. As a matter of fact, I saw news this morning where I think GS was, I got some terminal news this morning where GS had said, talked something about the rate hikes. They're now anticipating rate hikes by October of 2024. So this looks all like front running to me. That's what all this looks like, putting the risk back onto these tickers and then selling into you down the road. So let's look at another one here. SYM, Symbiotic, right? Same kind of a deal right here. Risk off, come swoop in, risk on right here. And this one's pumping right now. I've got another one over here, IoT. Take a look at IoT. Here's another pumper right here. SKWD is another one. Pumping. Jesus, it's crazy. GCT, all outperforming. We talked about the outperformance of small caps for the past couple weeks, right? And the crazy part is we're just getting started on these tickers right now. MRAI is another one. These are all companies that, well, now these companies I'm showing you here have only IPO'd in the last 3 years. But so that these companies are kind of late to the party. But if you were to compare these tickers to companies that got clipped that had IPO'd before 2020, you would see the same turnaround on them. So if you want exposure to that, the one thing I would tell you, and what's kind of weird about today is specifically is it looks like even people don't give a fuck, right? That we should be down this week today, tomorrow, not down, but slightly pull back this week into the 15th. They just don't care. They're like, if I'm out there with a red face screaming at people, yeah, don't buy these small caps until the 15th. And also tell them, and you're going to get outperformance into March. They're just going to load the fuck up. They don't care about price. They don't. There's like early FOMO going on right now with these tickers. And I want you to know if we don't get a rate increase, you should see that ramp. You're still early, I guess. You should expect that over that outperformance all the way into March. It's significant for the time period, so you'll have plenty of opportunity to jump on board that train. I'm sure I'll hit you over the head on it for the next month or 2 and 3, and then eventually March will come and you'll be like, oh shit, I missed that entire run. It's kind of like the AI run to an extent, where in the initial phases you'll hear people say, you guys remember the live streams where people were saying the AI is going to be a bubble and it's only going to last 2 or 3 months. Or I remember specifically people saying, it'll die in 3 months. It's just a scam bubble that's going to get created, right? 3 months passed, 6 months passed, 9 months passed, year passed. So just be aware of that with this as well. That you'll have people say small caps won't run. It's done. I don't know. It's done in January. It's done in December. Done in January. Done in February. Of course, it should ramp significantly. So that is why we're still holding up. You are seeing a rotation into all of the risk-off stocks from the anticipation of rate increases. Not when we raised rates, when they announced that they were going to begin to raise rates in the future. You can ask anyone. You guys remember, right? The indexes were holding up, and they were just cutting each sector off one by one. They were going through and surgically just destroying the small and mid cap side of this market. All right, that's all I got here. I gotta head back in. I'll be right back. There is another note here too. So I'm not gonna. Trader Podcast just asked questions. So I've got some charts here from that show who's net short and are they accumulating. These are banks like Goldman Sachs. Like is Goldman Sachs adding flows to these tickers right now? So you won't see flows coming into small caps directly from large banks. They're normally the elephant in the room. They come in late cycle. They're never early cycle. So normally what you'll see early cycle is you'll see whales and smaller hedge funds come in and start the accumulation. Market makers actually start at the beginning. So they accumulate on these bottoms. You start to see these tickers flatten out. Then you see some high-powered people come in. These are normally like high net worth individuals and also very small boutique hedge funds that begin to ramp this stuff up. And then normally you'll see a turn at the end where like a GS turns around and becomes net long. As a matter of fact, that's why we're seeing this run. That correction that took place this summer was a doorway for large banks to get super long. When you look at a bull run, and this bull run began in October of 2022, and whenever this bull run ends, we will then go back in time and be able to see when each group of investors or buyers got into that bull run. And most of the time, the late cycle bull run is filled with the likes of JPM, GS, these large fat elephants, these big fat banks. They're not early adopters. You won't find that they were in October. So that I would expect that by January March you'll start to see the turn on those charts. Let me show you one right now if I can find it. Hold on. See if I can explain this to you better, or even just show you something here so we can dig it out. It came out last week. I thought I posted it last week, but let me see if I can show it here. I might have downloaded it too. Let me see if I've got it in my stuff here. Hang tight. Let me see if I got it here. Might not even be available anymore. I'm not seeing it. Let me see if I can find it later. I'll try to dig it up. Harry, I'll do it tomorrow. At any rate, I don't see it here. I'll look for it, but client flows for B of A. See if we can see this here. No, that's client flows for B of A. Give me one quick second. Let me take a look through this. I'll see if I can find it for you guys. Hold on. Give me a couple seconds here. And I'll look for it here. What am I looking for? This is the JPM inflows. That's for SPX, though. You want a quick second here? Let me turn CNBC back on for you.
Anticipate growth into next year as well. We actually think in Europe there'll be an acceleration in growth relative to what we had this year.
Michelle, it's good to see you. Thank
Great
you
to
for
see you.
coming on and sharing the new research with us from MasterCard.
Appreciate
Chief
it.
Economist there, MasterCard, Michelle Meyer.
Still to come, you know about big tech's battle when it comes to search engines, but now messaging has Apple and Google back in the ring. That's coming up next when we're back in 2.
Yeah, I got some other notes here this morning. Goldman Sachs is saying it is worth noting that over the weekend, let me see if I can start from the beginning of the Goldman Sachs stuff from this morning. Goldman Sachs here. This was on the 8th. We continue to see an uptick in retail trading activity. Look no further than sub $1 stock volumes. They exploded this week, presumably driven by retail, and yesterday touched 30% of tape volume. 30-day average is around 10%. I got some stuff from this morning. Goldman's Privrotsky says there's a lot priced in now for a soft landing heading into December expiry. The baseline is for markets to drift higher and for momentum to underperform. But given a few important macro catalysts, the data and Fed need to play ball. More on that tomorrow. Watching New York Fed inflation expectations today. That was at 8:30 this morning. It is worth noting that over the weekend, our economists have brought forward their timing for the first cut from the Fed by 1 quarter to Q3 2024. They note the change does not reflect any major shift in their thinking, but rather that the rough thresholds for cutting they have been given previously, 2.5% year-on-year core PCE inflation, as well as acceptable levels of inflation expectations and wage growth, are now reached earlier in their latest economic forecast. They continue to think that the hit to growth from rate hikes is behind us, and that cuts are largely optional rather than being required to avoid recession. So possibly higher for longer, and then expect your first cut in Q3. Still looking for that chart. Let me see if I can find it and put it up for you.
Or hers.com.
Apple shuttering a third-party app that allowed Android devices to use iMessage. The messaging service exclusive to iPhones is something Google has long called on regulators to act upon. Our Deirdre Bosa spoke to the app CEO for today's Tech Check. Morning, Dee.
Carl, good morning, and congratulations to you and Sarah on Money Movers. It looks great, and we kick off a new Tech Check look as well with a new frontier in one of the biggest fights in tech of the last decade. It's a look, too. The blue versus the green bubble. Most people know exactly what I'm talking about. If you're messaging with an Android user on your iPhone, their message shows up in a green bubble. Features are missing like read receipts, media quality gets distorted, group chat issues. It is annoying for both sides, yet this divide has persisted for many years. That is until last week. There finally seemed to be a solution. A startup called Beeper found a workaround. Android users were suddenly and seamlessly sending blue bubbles, and group chats automatically switched over to iMessage. I spoke this morning to Beeper CEO Eric Migakovsky. He told me that the app hit 100,000 downloads 48 hours after its launch, and at $2 a month, it equated to $1 million in annualized run rate. But then on Friday, something else hit, and as fast as the app caught on, it was shut down by Apple, which said that it was a security issue and it was trying to protect the privacy and security of their iMessages. Migakovsky tells me that Apple's statement is, quote, completely false and does the opposite. He argues Beeper Mini makes communication more secure between iPhones and Androids. Senator Elizabeth Warren has weighed in also, posting big tech executives are protecting profits by squashing competitors. Now, it does raise the question, why would Apple resist better integration if security wasn't an issue? Well, there may be some clues, perhaps from other battles that Apple is fighting. An email from Apple exec Craig Federighi in 2013 on potential integration. He says, I'm concerned the iMessage on Android would simply serve to remove an obstacle to iPhone families giving their kids Android phones. He said, I think we need to get Android customers using and dependent on Apple products. So in other words, guys, iMessage and green bubble stigma, that could be a way of locking users into the Apple ecosystem, a way for Apple to protect its walled garden. Now, as of right now, the workaround at Beeper Mini still isn't working. I just tested it out, but I'm hearing that there will be some developments later today. I will be watching, and I'm going to guess, guys, that regulators, they will be watching closely as well.
It really does give you a sense, Dia, how important Apple thinks message is to staying in the ecosystem.
Yeah, maybe at the expense of a user experience as well. I mean, I'm sure you guys have heard it. I hear it all the time and think it when I'm messaging with Android users. It's just friction, and tech companies, all they want to do, their mission is to avoid friction, but at what cost, right? And it's sort of part of this really interesting dynamic and relationship between Apple and Google. Because remember, the other side of this as well, which has come out of other court proceedings, is how much Google pays, right, for the placement of its Chrome search and search in the Google ecosystem. So, you know, Apple on the other end is getting billions and billions of dollars from Google, which is, you know, key to their revenue growth.
It's bad enough that you can't FaceTime with Android users. We always give my dad a lot of grief for that.
Maybe that's the next workaround.
There you go. Deirdre, thank you. A battle you will continue to want to watch. Meanwhile, there's been a focus on the recent congressional hearing regarding anti-Semitism on college campuses. Now, University of Pennsylvania President Liz Magill announced she is resigning following criticism of her response at the hearing. At the hearing, when asked by Representative Elise Stefanik whether calling for the genocide of Jewish people would violate the code of conduct, Magill said repeatedly, it depends on context. That was clearly one major event that led to her resigning. I do want to give a shout out also to Bill Ackman, who's someone we cover, who's a billionaire hedge fund manager who has really been front and center in calling for moral clarity, I would say, at these campuses before this testimony and after this testimony as well. He sent a letter now to the Harvard Board of Directors because President Gay and also Kornbluth at MIT, neither of them said that calling for genocide of Jews violates the code of conduct and condemned it in any sort of normal way.
Even the head of the Board of Trustees I said this was over-lawyered and not well prepped. And even though the hearing was several hours long, not an answer.
They're going to be subpoenaed now.
Yeah, not an answer you should have given. Interesting to hear Jeremy Siegel, too, comment on it with a lot of candor from somebody who's from the inside.
Right. So he's a Wharton professor. We had him on last hour. He said he didn't see any way that Magill could continue in her role after that testimony, and he felt good about it. Didn't give us much more than that, but there's clearly a bigger problem here. It starts with the leaders, obviously, but bigger problem about why this certain speech is tolerated as free speech and some isn't.
We'll get Oracle tonight. Of course, CPI tomorrow, Fed on Wednesday. Interesting to see stocks hang in there, not reliant on every tick of the bond market.
Right, because bond yields are a little bit firmer. They were firmer after the 3-year auction. We've got 2 more big ones in the next 2 days.
We'll see that last. Let's get to the half.
Carl, thanks very much. Welcome to the Halftime Report. I'm Scott Wapner. Front and center this hour, the huge week for your money with critical inflation data The Fed decision, of course, the news conference to follow, and fresh reports on the consumer. Our investment committee debating all of it. Joining me for the hour today, right here at Post 9, Joe Terranova, Jason Snipe, Jim Leventhal. Dow's in the green. We'll show you the major averages. And by the way, as we do show you the market, you're going to notice our screen looks a little bit different today. It's all part of a new look for CNBC. We're excited about that. Over time, we hope it will make it easier for you to understand the market and the stories we are bringing you. But there's your check. Dow and the S&P are in the green. The NASDAQ is a marginal loser today. Take a look at the 10-year. You did have short-term inflation expectations from the New York Fed falling in November. So the 10-year is at 4.26. So, Joe, we begin with what lies ahead. And it's a big week.
Right. Let's
and maybe
see if
the
we
biggest
can
risk that we have to think about is that the chair, Powell, is more hawkish than the market thinks he's going to be, because the market thinking that the Fed is now its friend is the whole reason we're even here in the first place.
Yeah, his intention is going to be very clear to us, because he's going to be able to be so impactful on the market. He could literally take the rally that we've had since early November and arrest it with his words. So I think, however Chairman Powell wants markets to move from here, I think you'll hear that embedded within the language that he's going to speak about. This is, without question, a very huge week. Scott?
So let's take a look really quick on, give me one quick second here. If you look at this chart down here to your downside, what am I missing here? Anyways, down on this downside chart here, I want you guys to see this. So this is our K, this orange. Let's see if I can bring this up. So here is ARC K, right? And it's kind of important for you to see this whole area right here. This is as we came into December of 2020, 2021. And this just steep violence in our kitty. I'm having problems here. You can see this just steep violence in our K that took place. And I also want you to watch how Apple continued higher through this period. S&P 500 continued higher in this period. Then you saw Apple getting kind of clipped over here in 2022. S&P 500 getting clipped in 2022, right? You also can see Apple ramping, right? Big move into the Mag 7 over here. A little bit of underperformance here, but still up in S&P 500, and then this consolidation phase down below here. So if you're looking for these outsized gains that you saw back here, kind of the same thing should be happening in our K small caps in general. Just an overperformance. We had slight underperformance by Apple and S&P 500. You had this violent move down, and you're going to expect some kind of a violent move back up here into from now into March. Kind of like, I don't know that you get all of this back here, but like some of this you should get back, at least some of that, and possibly even some of that over here in that on RK or that type of small cap, mid cap, aggressive spec growth type stuff.
High, it's above 4,600. The rally's gotten more broad, equal weight to outperforming the S&P 500.
Yeah, I'm being attacked by my cats right now. They're like running around the office, knocking books down, all kinds of wildness.
has to come through with regards to inflation continuing to ameliorate. And Chair Powell, he certainly is going to say something marginally hawkish because he can get away with it, right? I mean, the markets, the economy, everything's hanging in there, so why not continue to be hawkish? There's no downside to it. The thing that would worry me is if the CPI comes in hot tomorrow. I actually don't expect that, all right? I think that the lagged effects of shelter, the clear decline in energy prices should put a nice downward trend on headline. Now, Scott, I know we're all focused and we should be on core and super core and that sort of things, but if I'm looking at the Cleveland Fed right now, which has
just like if you're a stock investor, if this is what you do is invest in stocks, everything that got annihilated. I don't know if you guys remember this, but I made a comment about it on Twitter. In matter of fact, in November, I think it was September. You know how to ask about this is ask Horse Lover Fat. Horse Lover Fat and I were getting out of spec growth together in late 2020, and there was a giant, just a noise, to continue to buy that stuff, and him and I specifically were like, "Now we're gonna go trade, the blue chips, the blue chips that are being supported by the liquidity being dumped in the market and the indexes." CNBC though was on this whole thing of buy all this stuff, like buy all these small and mid caps that were ripping off, just straight mooning, and people were buying them. They were loading up. Beginning of the year came. CNBC did this whole entire thing on like just buy, right? It was all bullshit. It was all, they were just selling into people, and that all took place. There was like a silent bear market for all those tickers, and it was pretty violent. I expect more of the same on the inverse here. Think about this from a market maker's perspective. They're going to look back at anything that got destroyed during the beginning of the rate cycle, of pre-rate cycle hikes, I guess, or because remember that. So the Fed used to not tell us what they were going to do, and Jerome came out and said, "We will be forthright from this point forward with what we're going to do." We used to get surprise rate hikes all the time, or decisions, and not know what was going to happen. They telegraphed these things in advance now. They telegraphed in advance they were going to begin a rate hike cycle, and so that's how it took place. Kind of why we didn't get the violent move down that everybody was expecting. By that telegraphing, the banks managed their hold on a second here. Take a look at this. The Fed basically, or not the Fed, but the banks basically managed distribution in their exposure to the stock market over time. It began in December, or November, December, January 2020 to 2021. Then went from, you can just easily see, they just went from sector to sector to sector, and they just cut legs off. Do you guys remember back when regional banks got destroyed, and then banks got destroyed, but mostly regional banks? Like, they were just going in sector by sector on any kind of strength and just cutting out the legs off from each sector one by one. So I'd expect that rotation to go back into the original stocks that were clipped. So you might want to, even if you're a stock buyer, if you're interested in stocks, stuff like that, not day trading or swing buying or, I don't know, fucking selling premium, whatever it is, I'd be going back and looking in the major lows of ARK-K for news articles that highlight what got clipped the most, and then be paying attention to those stocks over the next 1 to 3 months from now into March and see what their performance is. I'm not really one that cares about I care about fundamentals as long as there's no fraud and stuff like that, but just be aware that as long as a company has not committed fraud, that these market makers will make up news depending upon where price is. They will accumulate on lows. They will make them run again. They might not overperform like they once did, but they will run and outperform.
exposure there.
I don't see you guys, Joe's been making a bunch of moves, but I don't see you guys, Jason, you especially, making a bunch of moves in your own sort of personal chase for what you think lies ahead, even as you talk like you think there is room to the upside. I got no moves from you today. Jimmy, I've got no moves. Maybe it's just being content where you are. I don't know. You tell me.
So, for us, luckily, we have had a lot of exposure to tech throughout the year, and we've been trimming throughout the year. But as we get towards the end of the year, it is going to be about reallocating. That's why I mentioned positioning and looking to other areas of the market. We're talking about the RSP numbers, which is the equal weight index. Up almost 8% in the last month. There's clearly some movement there, and I think you're going to have to expand and broaden your horizon, look to industrials, financials, other parts of the market, and that's what we plan to do heading into new.
There are some sectors too that will get more love. I think I posted them last week for someone was saying what sectors to watch next year. There's some like healthcare equipment sectors to watch. I made another post about luxury goods over this weekend. That's a sector to short. And you also want to be looking at some minor stocks, stuff like that. I'll try to post them again. I'll post them more cleanly on Twitter if I can today. But you're looking for any sectors that have been destroyed by rate increases. Any of those sectors that have not come back and only run on the end of rate increases.
Not always. I think the benefit of the doubt has to go to the bulls here. Unless an exogenous event happens, something that nobody sees to really knock the global economy down, then you should expect profits to continue to grow next year. And most people, including me, are going to value next year's year-end target on 2025 earnings estimates, which right now are 275. If you put an 18 times multiple on that, which seems perfectly reasonable, you get to 49.50 at year-end. Now, we haven't put out our official year-end target, but I'm kind of hinting.
For next year?
For next year.
When are you going to do that?
You'll see it next Monday. We're working on it right now.
Okay.
So I'll believe me, I'll let you know. I'll let you know. But here's the point I'm trying to make on that. That's roughly a 7% return from here. That's fine. That's good. But it's not going to really light people's eyes up. I think where you're going to see bigger, better returns are the things that we're hinting at here. Small caps, the industrials, the cyclicals, the value sectors. Because if this economy continues to skirt a recession and you get continued strong employment, you get all that supply chain onshoring and CapEx spending continuing on, then these undervalued sectors of the market are going to see better earnings growth than expected and better returns.
How about this, Joe? Ari Wald over at Oppenheimer says it's banks. It's regional banks. To Jim's point, regional banks are the thing that's going to take you to new highs, a new cycle high in the coming months.
Regional banks. Not necessarily sure that regional banks are going to take you to a new cycle high, but I'll tell you, if I'm looking at financials, I actually want to own regional banks over money center banks.
See how this guy is talking about regional banks right now?
Deceleration from where
they are going to run these bad boys up. They're going to get them all hot and saucy. This guy knows what he's talking about. This guy's talking about all rate-sensitive stuff.
In an environment where the soft landing narrative has the potential, the growth in loans comes from regional banking itself. So I like regional banks, and I think with all these price targets, what's most interesting is not the destination, but the journey. Tell me what the journey is going to look like, because, Scott, I don't know that you're going to get 15 to 20% higher for the equity market in the first half of the year. I think that's really going to be a second half of the year story. And I think that's important for the viewers to understand that the journey might come with a little rough terrain in the first half of the year.
This is a great point, because it's not just the rough terrain, but it's the duration of the journey. We're talking about regional banks. Let's not forget.
There's one other conversation piece here, too. We're going to have to spend some time. If I have time today, we'll look at it. But there is a bull trap in here. It's not guaranteed that it takes place, but there's a bull trap depending upon price of the S&P 500. Whether we're above, excuse me for 1 minute. Excuse me for one quick second here. So even though we have that run coming up, or an expected run with outperformance in IWM into the beginning of the year, I do want to still warn you that in play is where price on this run ends. Does the price of S&P 500 make a new high from the high of 2022 in January or not? It's critical here that we get that new high, and I would prefer to trade above it to give some cushion on a back test. If any of you guys know anything about Wyckoff distribution models, it's going to confirm whichever distribution model we are in the marketplace if we get that new high, back test, and just continue moving up, or if we fail to get that new high and begin to back test the lows down at 3,500. So we will monitor that as we head into the beginning of the year. How bad does it get in February and April? Or if we're chasing to the downside to get those rate cuts by October. We'll go over that. We might spend some, if I can get that done today before this rate decision on Wednesday, we will. I need to go over it with you guys so that you understand the mechanics of it, because there could be that euphoric moment in the market on this run, and the idea being, yeah, we get this euphoric moments, and then we're going to go keep pumping to the upside and pumping to the upside, and we end up getting trapped, and they run us all the way down, and you're in some pain. So we'll look at how far out they typically begin that front run. That could be part of the conversation too, is in that rate meeting having Jerome continue to threaten with rate hikes, even though we know he won't. But then when do we trigger that back test? There will be one way or another, is the point. The ultimate point here is that ultimately there will be a price check, a back check that will be triggered. There'll be a front running of that by banks as well. So we'll talk about that later today if we can, or rehash it and talk about it later today. Yeah, it's about the journey in stocks. I don't know if I heard that, but there's risk. There's still risk for a back test to the downside that could get extremely ugly in the marketplace. Now we know where to look for that. We know if price breaks below the hourly, the daily crosses through the weekly, that we're going to head down there and do that. But we're not there right now, so until we begin to head down there, there's not as much concern unless that begins to happen.
want to stay up to date with the latest and be on the bleeding edge of news for non-farm payrolls? Then sign up today and get our special offer of Financial Juice Pro for a year's worth of our service for the price of 1 month and save 92%.
Check 1, 2.
In a little bit, Mike Santoli joining us here. Up next, today's halftime headliner, a Heisman winner, college football coach, money manager, Eddie George joins us live at Post 9 to discuss all of that. We're back in 2 minutes.
To opportunity.
All right, welcome back. Heisman winner, NFL All-Pro, accomplished actor, college football coach, wealth manager. That is Eddie George's impressive resume. As you see, he's our special guest today at Post 9. Welcome back. It's good to have you back.
It's been a long time. Good to see you guys. Happy holidays.
Yep, and you as well. I know you're in town for the Heisman Trophy presentation as a past winner. Which never gets tired, I'm sure.
You know, it gets better in time. You know, I talked to the young man, Jaden Daniels, who won it this past weekend, and he's getting thrown all over the place. Like, they have him going to the stock exchange. They got him pulled here, doing interviews and signing autographs. You got to sign 300 balls as a Heisman winner. That's your reward. You get the trophy, and then it's off the press, and you have to sign all these autographs. So that's trust me, it gets better after this.
And then you get to hang out in the Heisman house with you. So it's it's all good. Look, so you've done so many incredible things, as we said with your resume. Let's talk wealth management first before we pivot into some other areas. One of the reasons you got into wealth management was because you wanted kids coming out of college, like the young man who just won the Heisman, to be more financially literate. And you felt as though we weren't.
Right. And it's just being set up for success. That's right. You know, coming out of college, going into the NFL, you're going to come across so many different people, different characters. They all want something from you: your time, your money, your energy. And I wanted to get into the business to help guys, just coach them through that side, that transition. You know, especially on the financial side. It's just about preserving your money. You know, we're not trying to make you money. We don't want you to lose it. We want you to have income after you retire, because once your playing days are done, it's tough to find that next thing, that transition, your purpose, your life purpose. And to be financially sound is a big part of that. And we want the guys that we're with to preserve their financials, and that's why I really got into the business. And I've been in it for almost a decade, if you can believe that now. And we're really thriving and doing well.
Well, your partner, Greg Eastman, through Ameriprise, was your own financial advisor for a long time,
and that's
right?
the key. It's the relationship. I've known Greg, since 1996. My first game against the Kansas City Chiefs, he was there on the sidelines, believe it or not. And he helped me get a pass from my friend to get on the field. I'm like asking this dude, like, well, can you give me a pass from my buddy on the sideline? Long story short, we became good friends. He's been my financial advisor, now my business partner for well over 30 years in the business. We always talk strategy. We're always talking about the markets, what we're doing really well together, and just really excited about it right now.
How many clients are former athletes?
I would say right now about
current for that matter.
We have current about six to seven current athletes. A couple of them are retired, and again, we put them in vehicles that are going to produce income after you retire.
Like Apple and all these other names.
Hey,
what do you guys
the Magnificent Seven, baby. The Magnificent Seven. That steady Eddie. It's working for you. You got your Apple, Amazon. Your energy sector and your tech sector. So we just, if it works, it works, and that's what's been really doing well. I think one thing we've been able to do is take advantage of the market now, where inflation is pretty high, and the municipal bond area. We've gotten some good returns on that as well for our clients. So. That's our core. That is our identity, is sticking what works.
So now you are the head football coach at Tennessee State University. How's the transition been to actually being a coach of young men, and what are your greater aspirations there?
You know what? I'm a leader who's coaching football. And the things I'm talking about in the financial world, I'm talking about life skills, preparing them for life through the prism of football. And that being financially literate, that's being professional, being on time. All the things that I thought was corny that my coaches used to talk about when I was growing up, I'm using now because it applies. All the small details that don't require talent for you to be successful, for you to be great, that's what I'm preaching day in and day out. Are you an asset or are you a liability? Assets, they come, they produce, they encourage one another. It's a positive atmosphere that they're creating, and they're helping their teammates raise the standard. Or your liability, not showing up on time, bad attitude, bad energy. So that's what I'm doing for coaching. And I'm trying to win a few ball games and championships in the process.
How do you compete in what has been an unbelievably changed world with NIL, name, image, likeness, where kids are getting millions of dollars to play college football?
How much time we got?
Yeah.
Am I on this for a couple segments? Because listen, that's the hot topic, and at our level, it does impact us. But again, are we setting up our kids for success? We're talking about kids making almost $20 million, $5 million. Kids are jumping in the portal to get a different bag every day, and if they get that bag, Uncle Sam's going to come knocking. So you've got to be set up for success. You've got to understand that money, half of that's going to go to Uncle Sam. And do you have the right advisors around you? Do you have your LLC set up? I mean, so it's very important that, we're throwing money out there. They're saying kids can go and get money off their name, image, and likeness, which is great. But there has to be guidelines and rails around this thing, because kids are going to get hurt because of this, financially speaking, once they get out of the game of football.
Do you see yourself being a coach, whether it's at the current school or somewhere else, maybe even the pros down the road? Is that what you want to do?
Scott, I've done so many things, man. I've been on Broadway, Chicago a few years ago. If that's in God's plan for me, I'm going to do just that. I'm right where my feet are planted, and right now, I'm coaching football. I'm preserving the wealth of my clients, and if the NFL or another opportunity is in the works for that, it'll work itself out. I'm totally open for it.
Yeah.
Sure.
Joe?
It's awesome. Let me ask you, if you think about the time management that a lot of these kids have right now, and you reflect on your time management when you were a player, how critical do you think that is? Because it seems to me that we fail in messaging to the youth of today, how they manage that time, and how do you get your players to understand that?
You know, time is such a value. It's such a commodity that you cannot buy. Unfortunately, I'm segueing into this, but I lost a dear friend of mine just yesterday, Frank Wycheck, former teammate with the Titans, died at 52. And you don't know how much time that you do have on this earth. So I tell my kids, you know, set your priorities. What is your legacy vision for your life? I have them write this out in grave detail about where do you see your life at? Going professionally, family-wise, spiritually, everything. And then that is your compass. So every decision that you make from this point on, when you wake up in the morning, is geared toward that vision and toward that purpose. And that's a relationship that you have to have with God. I mean, honestly, you have to have that higher calling to know what it is that you're here to do and live to that on a daily basis. So I try to tell them, listen, you got time for partying, that's great. Yeah. You got time to go hang out in the quad or whatever with the kids, but when you wake up in the morning, if you want to be an All-American, that's All-American work that you got to put in. Right. Every single day in the classroom, in the weight room, and so forth. So that's what I would say.
All right, 6-5 record this year. So you have a winning record. A shout out.
That's some meat on the bone.
A shout out to your son.
Should have been 9 wins or 10 wins, but yeah.
A shout out to your son as well, who plays for you, and who was on the freshman All-America team. We wish you continued success.
Thank you, guys. You guys too. Good
stop by anytime you want.
I think I'll come by next year. How about that?
Okay.
All right. God bless you, man.
That works.
You. Happy holidays.
Well. It's Eddie George joining us here at Post 9. Final trades are next.
off.
today.
3 o'clock closing bell. Hope you'll join me then. We got Greg Branch. He's been a bear for a long time on this market. We'll find out if he's changed later today. Gabriela Santos, Ed Yardeni. He has a huge target for stocks in the next couple years. We'll reveal that when I see you at 3 o'clock. Let's do final trades. Farmer Jim.
Cisco Systems. You may remember when it reported earnings a few weeks ago, it gave disappointing guidance. The stock, the estimates all had to reset, and that's been done. Last few days, you've seen some nice momentum in it. Expect that to continue for this steady Eddie dividend payer.
Okay, Jason Snipe.
I like Goldman Sachs here. I think underwriting is clearly bottoming. I think you could position here in 2024.
Okay, Joe T.
Chip name we don't speak much about, KLA Corp, ticker symbol KLAC. Reasonable valuation, chips exploding higher today. I think the stock continues to go higher.
Why is it up 5%?
Chips as the industry itself all higher. Broadcom up 8% today.
Wow. All right. Thanks for noting that. I will see you at 3 o'clock. Dow's good for about 91. Of course, got CPI tomorrow. Got the Fed after that. Retail sales later in the week. We've got a lot to cover this week with you. I'll see you in a couple hours. The exchange is now.
Thanks very much, Scott. Hi, everybody. I'm Dominic Chu in for Kelly Evans this afternoon, and here's what's ahead. Inflation data, the final bond auctions of the year, and the final Fed meeting of 2023 is on deck. Any one of these could become a big market event, but if you're hoping it will shed light on when the first interest rate cut could come, there's an entirely different data point you should be watching, says one of our next guests. And it suggests we could still be far off from the Fed making that particular move. Plus, Sherry Redstone reportedly in talks to sell a controlling stake of National Amusements, but why now? And what could that do to the rest of the media landscape? We'll have new reporting on that ahead. And Macy's shares are surging on a possible buyout offer, but is it retail or real estate that the buyer is after? We'll have the latest there. But before we get going, you may have noticed that your screen looks a bit different this morning. It's all part of a new look for CNBC that we're very excited about. Over time, we hope it will make it easier for you to understand the market, the data, and the stories that we bring you. So hopefully take it all in and see what happens, and we'll go along this journey together. And we begin with this particular chart, which is the 10-year bond auction now underway. Yields currently sitting right at about session highs, 4.28%. Rick Santelli out in Chicago crunching the numbers. He's going to join us momentarily with the results of that auction. All of this as long duration auctions have increasingly become bigger market type moving events. But what will we get today set the tone for yields from here going forward? Now, for more on what to watch and how to position into the new year, I'm joined by Brian Weinstein, Morgan Stanley Investment Management's head of global markets. Also, Brian Levitt, Invesco's global market strategist, the two Brians, if you will. I'll start with the gentleman standing right to my left, Mr. Weinstein. Let's talk about the yield picture. I noted that the 10-year benchmark note yield is at session highs, but session highs is a hair over 4.25%, 4.28. It's a far cry from where it was at the cycle highs, maybe 5.02% this time around.
Yeah.
What do you make of the move, and is this a new regime for yields at these lower levels?
Yeah, it's an interesting question. I mean, listen, we came a long way, right? No one thought we'd see 4.25 this year. Then we blew through it up to 5, and at 4.25, 4.28, is it cheap? I guess we're about to find out. I think it's a bit of a new regime, right? The Fed, even if they ease, they're not going back to zero. Inflation is still out there somewhere. Growth still seems strong. So I think it's hard. We had 10-year notes closer to 4.07 a couple days ago. That's a tough level, right? You're really betting on a lot of slowdown. I think when you get in this 410 to 450 range, you'll see a lot of work being done in here because we didn't do it before on the way through.
So the resistance you're saying is at that 4 big figure type level for the 10-year?
I think it's hard to get through 4, right? I mean, you really have to have inflation slowing well below 2. Maybe you have to have negative payrolls, a Fed that's easing very quickly. All things people like to discuss as we go into year end, but not things that are happening right away.
Brian Levitt, how much has the interest rate narrative?
Just to note that we are beginning to break through that previous P2 right now, looking for that also that P3 above here. 462.08, want to see that new high if possible.
being treated poorly because interest rates would move further higher. And as a result, you ended up with a very narrow market. Investors were only bidding up those names that they thought could do well if the Fed had to really tighten the screws more on the economy. And what's happened since, as the market has become more accustomed to a so-called soft landing type of an environment, or an environment where the Fed may ease in the coming year, then we've seen a broader market environment, which is healthier. You've seen greater participation from value stocks, from smaller capitalization, non-U.S. dollars, so international investments have done well. So it's been a move. It's actually not all that different than what we saw from the middle of October in 22 through most of the first quarter of 23 until Silicon Valley Bank failed, where you had a soft landing trade. And then that became a lot narrower as interest rates moved higher. We've reversed that, which is nice.
Brian Weinstein, one of the interesting dynamics overall, it's not just treasuries that are getting that bid. You're seeing the same thing from liquid corporate investment grade type securities, higher rated securities. At the same time, people still feel like they're yield chasing, if you will, some of the investment grade and then even high yield debt markets. Leveraged loans still seem like they have some sort of interest out there. Bank loans, that sort of thing. What exactly is the layout right now? How would you be distributing that kind of new capital that comes to the market within fixed income?
Yeah, listen, I think what people got wrong this year, they're now chasing, right? So this year was supposed to have more defaults. It did, but not a lot of big ones, Silicon Valley Bank. So high yield spreads near the tights. Levered loans, which nobody liked, have a 10% return handle, right? Great coupons, not a lot of defaults. I think we're chasing the value out now for 24 is the problem, right? You look at high yields, look at investment grade, and the spreads are closer to the tight end of the range than they are the wides. So if we do get some slowdown, if we do get some return volatility, I think it's actually harder to own those risky assets into 2024 than it seemed like it was going to be a couple weeks ago. As Treasury volatility falls, which is one of the things we're seeing here, right? So if we don't have a big unexpected range, the first reaction is for risk assets to do better, leadership to shift, as Brian just said. I think on the tail end, the question is the credit backdrop really that much better if the Fed stays at 5.25? And I think it's more difficult than here than it looks. So I would actually start to go more risk off than I would risk on at this point.
Brian Levitt, does that kind of at least agree on the market side with what you're seeing in the stock market right now? We've seen some of the mega cap technology stocks maybe lose a little bit of momentum here. Some of the interest rate sensitive sectors are starting to see a little bit pickup in volatility. What exactly does the first quarter look like given the rate backdrop as you see it right now?
Yeah, we have it as a risk-on trade in the first quarter of the year. It's market sentiment is pointing ahead to an economy that, yeah, again, navigates this soft landing. Now, we're not naive to the fact that you won't slow down some as we progress through 2024. So what that would mean to me is tactically right now we favor things like value and small cap and international. You're likely to see a shift towards a more quality trade at some point in 2024, and we'll be monitoring that daily to provide guidance on it. But ultimately, if investors are trying to look out beyond a few minutes or a few days or even a quarter, what does the next couple of years look like? And in our opinion, what we're going to end up having in 2024 is a mid-cycle slowdown, policy easing to bring the funds rate down closer to where nominal growth is. And then you're likely to be in a better risk-on environment once again. So if I'm positioning for the next few years, which is in the aftermath of peak inflation, peak tightening, and peak interest rates, then I want to be more exposed to broader parts of the market, less exposure to the market cap.
Mr. Levitt, hold that thought. Mr. Weinstein, hold your thoughts, because we do have the 10-year note auction results out right now. Rick Santelli standing by, tracking the action out in Chicago. Rick, what can you tell us?
Well, I can tell you that the demand, well, I gave it a C-, so a bit below average, and I was probably a bit generous, but I think that the well was poisoned a bit by an extremely weak 3-year note auction at 11:30 Eastern. So we had $37 billion, 10 years, a reopening, second auction of the day, yield 4.296. The problem, Dom, is the when issued market was hovering around 4.28. So a higher yield equal a lower price on the auction itself, and that was the biggest reason to give it the marks I did. But to put it in context, the markets have been selling off most of the session. It accelerated after the week 3 year, so going into this was already a bit of a handicap. And tomorrow, of course, we finish off 108 billion in supply, last of the longer dated Treasury auctions of the year with 21 billion 30s. But C minus 4.296. The metrics were all very close to the average outside of pricing, although the dealers taking 17.3% is above the 14% auction average. And even though you see yields slipping a bit, don't fall into the trap of trying to assess demand in an auction purely by the response in the marketplace. Big responses, yes. Subtle responses like we're seeing now is more a function that we've already elevated 10-year note yields up about a handful of basis points on the session already. Dom, back to you.
Rick, if I might just follow up quickly, we saw that the bid to cover was $2.53 worth of bids for every bond at auction here, slightly better than average. What can you tell us about that indirect bid? Because a lot of folks like to use that as a proxy for foreign interest central bank buying of U.S. Treasury debt.
Absolutely, and it is indeed, and it's one of the important metrics along with direct bidders, and direct bidders are large institutions that, of course, need the longer dated paper, but 63.8 on indirects versus a 10 auction average of 67%. It's close. It's been rather volatile of late, and I also take into consideration, Dom, that this is a reopening, so you have to somewhat blur your eyes a little bit on some of these metrics. But all in all, foreign bidding is a little bit lighter than it's been, and it's been slowly slipping over the course of the last year or so, as many of the larger buyers refrained or actually turned in a bit of sellers. But we have noticed recently that we're starting to see some interest from some of those that stood down on the auctions, like the Chinese, the Japanese, and the Saudis.
All right, Rick Santelli out of the CME Group in Chicago with the latest bond auction. Thank you very much for that. Let's turn back to Brian. And Brian, we're going to give both of you one last word on what's going to happen here, given what we just heard from Rick Santelli. And Brian Levitt, I will start with you. Knowing what you just heard about the auction from Rick and the state of interest rates right now, what do you think from your investing landscape macro view will be the biggest difference between 2024 and what we saw in 2023?
Well, the first thing I'll say is I'm glad I don't take Professor Santelli's class. C minus seems a little rough. That didn't seem all that bad of a report, and I am not overly concerned about losing demand for U.S. Treasuries. Treasuries will reflect the nominal growth rate. Look, this was a year in which things got significantly better relative to expectations. Inflation came down rapidly, and growth was resilient. So you had a very, very big year in the broad indices. I would think next year you'll see more modest. You're not going to see the same types of returns, but I think the market's going to do just fine next year. There'll be different regimes. You'll have a start of the year where it's broader. We'll probably go through some slowdown where investors may want to favor higher quality. But to my earlier point, ultimately, I view it as a mid-cycle slowdown and the beginning of the next stage of this cycle, and that should reward those parts of the market that are undervalued. Again, I come back to small caps and I come back to international.
All right, Brian Weinstein, your final thoughts, the biggest difference between next year and what we just saw this year.
Yeah, I think this year we saw a lot of pressure on the front end of the yield curve, which eventually kind of filtered through to the back end. And people started talking about supply and government being reckless and all those things. I think next year is also more balanced. I think it's about a Fed that will eventually ease. But the other backdrop is an election year, a government that will continue to spend. So I expect curves to steepen by the front end continuing to fall in yield over time. And I'm not so sure about the back end. Right? I look at 10's bond spread at about, 8 or 9 basis points right now. The problem we have isn't the Federal Reserve. It's the government spending. And I think that will rear its head again. So I think Brian's right. You have to be selective. It's a stock picker's market. It's a bond picker's market. High yield will be fine in parts, but you can't just go and buy the whole thing anymore. So I think more selective on the yield curve, buy 2s, 3s, 4s, 5s. More selective in your bonds. Don't buy the index, buy things that you've done research on, because it's going to be a lot more diverse, I think, in results this coming year.
Diversification, a theme for bonds and stocks. Brian Weinstein, Brian Levitt, thank you both very much for your thoughts. We'll see you soon, guys.
My pleasure.
All right, let's turn now to the Fed. Our next guest says we will still need to see more decisive loosening in the labor market for the Fed to actually start cutting interest rates. So joining me now is Michael Darda, chief economist over at Roth MKM, along with our very own Steve Leisman. You heard the conversation just now between Brian Levitt, Brian Weinstein with regard to the current state of play vis-a-vis the bond auction that we just got from Rick. Given all that, Steve Leisman, can you give us the setup for what the Fed is going to deal with this week and what kind of commentary we could get? And, of course, what those so-called dot plots are and what they could mean.
So all those are good questions. Yeah, I think the bond market auction ended up being okay. I see the stocks were relatively unchanged, maybe even a little bit higher on the auction. So it ended up being a non-event. I think we still need to watch carefully, as we've been doing each one of these auctions. I think tomorrow is another event. It's a lot of paper, and the market seemed to digest today's pretty well. As for the Fed tomorrow, or tomorrow and Wednesday, I think that Chair Powell may remind us what the phrase higher for longer means. Because if you stop the phrase higher for longer, it begs the question, higher for longer than what? And higher for longer than we thought they were going to be, but I also think higher for longer than you think they ought to be. I think that's maybe the key way to finish that phrase, Dom. And I think, so the point is when you think the Fed ought to be cutting because you've had a couple rounds of good inflation, I think that you're not then embracing the idea of higher for longer. It is just the time when inflation comes down and starts to behave that the Fed will invoke this idea of higher for longer, because I do think that Powell's major concern is not being the guy who started to cut rates too quickly. I do think cuts are in the cards. I just think the market is ahead of itself here.
Just going to pop in really quick here and show you guys some. See if I can show you this here. See if we can catch a squeeze here. Where's my screen? This is SPX net delta right now. You can see we're getting a nice ramp up here. This is 0-8 stuff starting right around that 12:49, 12:59 in the afternoon. See it pushing higher right now. I'm also going to show you, let me see here, SPX call put delta. It's going to show you not too much here. Put delta coming a little bit up here, or the put delta is coming up a little flat on the call delta. Delta flows, this is SPX call and delta premium. You can see the crossover taking place right around that 1 o'clock mark. And then gamma. Put gamma still just dogging down here, whereas call gamma is on the rise right now for a squeeze higher.
Than starting to ease too soon and having to reverse course.
Michael, with that in mind, is there a level that you're looking at for key economic data with regard to what would tell you whether or not things are, I mean, all clear is a rough way to look at it. I understand it's not that black and white, it's multiple shades of gray. But what kind of economic data has to come through to make you sense as though the Fed feels a little bit more comfortable about the environment? Is it jobs-related numbers? Is it retail sales? Is it inflation prints? Sentiment data? What exactly then has to be put forth in a portfolio of data for the Fed to be able to now say, yes, let's ease things up a little bit?
Well, I'll give you my perspective and then what I think the Fed is thinking about. So nominal GDP growth has run at double digits on average during this cycle. If growth potential is running around 2%, then you're going to have a big inflation problem. We think we probably finished the year with an average of about 5.
So someone just mentioned Bitcoin. Bitcoin should catch a bounce. They've been bouncing down here. So Bitcoin bounced at 9 p.m. on Sunday. Coming back down to check its bottom right now. The daily trigger is coming up at 39,678.84. So if you're at home right now, you're going to be looking for a bounce down here on Bitcoin. I'm going to give you that target one more time. 39,678.84 is what you're looking for. Not bearish, though, in any way, shape, or form. Just a heads up. Maybe I'll show you guys this. Hold on. Let me see if I can bring this over to you guys here. So, this is Bitcoin on your bottom left-hand side of your chart. Bitcoin's still very bullish. Nothing has changed on, excuse me, on Bitcoin. So you are looking for nothing's bearish about Bitcoin. It's just pulling back. So you're looking for a target down below again of 39.67.8.84. You're looking for a dip buy down here. And you've also got an hourly trigger above at 42546.20. This hourly trigger should come down and you should see some consolidation down here, okay? So you're just looking for some consolidation down here. Get back above 4,100, 4,200, we should be right off and running once more on Bitcoin. So as long as we stay above that daily trigger, just normal pullbacks, and then we continue to run higher. SPU's squeezing right now. Showed you guys those put call stuff, that ramping in the background there. Did you guys see that? Yeah, you guys saw that down there.
Time, Dom. Powell wouldn't entertain the question. He was asked about cuts. Powell said, we're not
Slamming into R1 right now.
stop on the question. I don't know he gets away with that tomorrow because one of his main governors, Fed Governor Waller, has talked about the idea that if inflation comes down, the Fed will be cutting. So a conversation has to be started, but you can bet right now that the Fed is trying to figure out what that language is going to be in a way to limit how much the market prices in.
The devil is in the details for sure. Michael Darda, Steve Leisman, thank you both very much for the conversation there. We'll see you soon. Coming up on the show, Macy's shares are surging after a group of investors made a nearly $6 billion buyout offer for the retailer. We'll look at what the buyout would mean for the legacy store itself and the rest of the retail landscape. Plus, fraud in a bottle. Exclusive access to one pharmaceutical company's war room where tens of thousands of confiscated counterfeit pills are being stored. We are tracking the millions of dollars pouring into some of those schemes. The Exchange is back after this.
This is The Exchange on CNBC.
I'm also going to let you know up here, just one more thing. This is a key thing, okay? I want you to be hyper aware of this. But I don't know if anyone's talking about this out there, but this is going to be a moment right here. This 46204 is big. This is the top from March. So this will be exciting to watch as we come up here. There's more like these. If this is like the March top right here, and then this is the January of 2020. This is 2022, by the way. This is this is going to be a major reaction point right here. This is 480.08, and then there's another major reaction point, and we're coming into it right now. So this is going to be fascinating to watch. It's either going to be we squeeze up here and straight red bars to hell, or hopefully you can get a nice blast above it and then come back down it and hold. But expect volatility is the point as we come up here. This is this just right up in here. Expect some fireworks of some kind as we go up there. Okay, just be hyper aware of that up here. Yeah, I'm still sitting in. I've got a bunch of what do I have? So I held over the weekend 463Cs. I paid 16 cents for them, and they gave me an out earlier. They're like, do you want to get out right now? And I'm like, nah, fuck this. I'm already down so much on them. So we ended up going down to like 2 cents, I think. I bought another fucking full round of them. They were goddamn dirt cheap. So I've been loading up that ticker, that 463, but I don't think we tagged 463. R2 says we can go to 462.91. So I'm hoping to just break even or get into the green on them if I can, so I don't lose the trade. But be careful up here. This isn't so this PT3 is not R2. Just be aware of that. This is 462.08. So right here, somewhere in here, there's a big question mark. In the bottom of your charts, I'm posting it in there right now, that big yellow bar. I've got question marks on this. Hold on right here. Those right there and just see what all that's going to end up meaning. Yeah, I'm hedged for so like right now I've got a hedge on for the jukebox. I've got a hedge on for Wednesday, and all I'm doing is trading 0 dates until we get there. Yeah, the bond auction, the thing about the bond auction is I heard CNBC talking about the bond auction briefly. It matters and doesn't matter, matters and doesn't matter. It's weird. Like HYG is just closing gaps on the up and down side. If you notice, as the curve uninverts, uninverts, it's gonna matter, and then it's not gonna matter. This is a prime day to be looking at. It's a prime day to be seeing how the 10-year does matter sometimes and doesn't matter other times. This looks like all algorithm right here to me, so I want to see what that reaction is up here. I've been looking at this now for a couple days, or I think since Friday or Thursday or Friday of last week or something, and just the mechanical moving up. I thought they would do it over the weekend. I really thought, I was like, if there was a best time to tag these things, it would be for futures if you can't get it done in cash market, you get it done in futures. That's the general rule. But I could tell last night at like 2, and I checked at 2 a.m. and 4 a.m. To see if Euro would buy it or if Japan would buy it. Nobody bought it. So now it just becomes a mechanical operation, right? They're just going to send this fucker up, and they're going to chase. So they'll wind up chasing this or trying to sell this down in the overnight next time. So this grind higher here, we got the first one. Then we got the second one, and now we're just looking for this last one here, this PT3. I do expect some sellers to. That's going to be a place of point of interest for sellers to step in and see if the demand there to sell is still stronger than the demand from buyers here, which I expect.
Abandon the whole store idea. They usually use stores just as a place to make returns, do curbside pickup, but Gen Z sees stores as a place for community. So that could be a place for, whether or not they'll go to a department store remains to be seen, but there is value in these boxes at malls. Malls right now, they are splitting up these boxes. They're turning them into housing. If you can believe it, people are actually living at malls. It's becoming senior housing. They're becoming these community.
The question becomes why. The question it's very complicated. It has to do with and when we have an inversion, where the inversion is. It has a lot to do with other factors, including inflation, unemployment, jobs, the Fed funds rate, the expectation of the funds rate to continue to the upside or to pause or it's coming down. So there's about 5 major mechanics of when the yield curve matters, or even just the 10-year note. Historically, we've gone through this at this point. If you've been in this stream long enough, we've been going over this for 2 years, 3 years, something like that since the beginning. And we will revisit this today or tomorrow before this rate decision, and we'll take a look at why and when the yield curve matters. It's why oftentimes you'll hear doom sellers they like to use the tens and twos or tens and threes as a vehicle to get bearish in selling a viewpoint. You know, if tens are going up, market's going to crash, right? Market doom. But in truth, it doesn't. It's one of the poorest standalone indicators for the market going up and down historically. It's right about 60 to 70% of the time, especially with going up and down. The Fed funds rates, the unemployment rate, and jobs rate and inflation are combined. Those three or four, like 3 plus the jobs could be like a sub thing, is way more predictive of market performance. As a matter of fact, if I were to tie it down to just one thing, it's always unemployment. If you had to use a hammer, it's usually unemployment's your best indicator for the moves in the marketplace, or like most consistent. But we'll go over it again. I don't know if I have the time right now, but today or tomorrow, we're going to look at all this stuff because it is going to be important heading into this rate decision for future expectations in the macro environment. Yeah, they're beating me up in here again for a penny. Like we're just at I think 4 cents and 5 cents. They just dumped me a penny down to 3 cents. So these these fucking dealers, dude, they are not pretty today. Another day, another session. What is this, like 14 sessions, 15 sessions at this point with this sideways bullshit? It's getting kind of ridiculous at this point. Oh yeah, you know what's crazy about that too? So like Stretching Walls is saying Powell is gonna sit us all down and remind us what higher for longer really means. Like, I got to be honest with you. If he does not raise, right, no matter what he says, history says that was our last rate cut. That's going to be important, an important thing because they're pricing in right now. They've been pricing in that same fucking lie, right? The last 2 or 3 sessions, last 2 or 3 rate decisions, when he was breaking out all those charts and just fucking painting shit on a wall to see what would stick. That doesn't make it real, and they're gonna front run his ass on eventual rate cuts. If he doesn't raise, he needs to raise to reset that. He needs to raise to reset the motion of where the market is heading. There's a front running taking place behind the scenes, and this is his chance, man. I don't even really care if he does raise in 3 months or 5 months. He's triggered this motion, and it's going to confirm on Wednesday, where they will try to front run an eventual cutting of rates. This will be the nail in the coffin if he doesn't raise rates at this rate decision. It's gonna be fascinating to watch. This is the one it's got me on the edge of my seat eating popcorn, waiting to see what he does. Probably the most consequential rate decision that he's had so far. Yeah, I agree, Station. Well, like he's gonna have to if he doesn't raise rates, man. I want to see what he does here because he already broke out all the big charts. He already broke out like the 10-year shit, like 30-year shit. Like this is where we think we'll be in 10 years, 20 years, 30 years, and I was like, you're out of your fucking mind. That shit is worthless. That's like the charts that he like. I think this was 3 rate decisions ago. Breaking out those charts is like looking at vol skew for the upcoming year, right? Or, this is the vol picture for next year. That shit is worth like the next 1 to 3 months. It's garbage. It's utter fucking bullshit. And the shit that he was breaking out, I was like, this is insane that he's actually breaking this stuff out because there's so many unknowns that can change that picture, right? If they had broken out a chart. If they had broken out those charts just before COVID, of course, no one priced in COVID, or a few people did, but not, not the big boys and stuff. They were telling you everything was fine except for one guy in CNBC, I believe Bill Ackman. But yeah, it's paper. It's like toilet paper whenever they do that stuff. Yeah, exactly. I don't know what they're gonna do. Like, he is due for a victory lap. I'll give him that. I mean, has he really taken does anybody know if he's actually taken a victory lap? He took one victory lap where he said if I recall correctly, that this whole thing was not this whole thing. He came out. It was kind of funny. He came out and he was like, "Well, we did the job we were supposed to do, which was to get the business cycles." From the business cycle from COVID back in line with the normal business cycle. And he took a quick victory lap on that rate decision. This rate decision, does he take a victory lap for everything being put back into check, or that they're doing their job? That's possible. I guess you could either get one or either extreme. You're either going to get the second victory lap for the greater market, or you're going to get the Jerome Powell like trying to talk doom to you, where that he tried doing that last time with all those charts and stuff. Just something absurd. I hope he doesn't do that. When he does that, to me, he loses credibility with the market. He this is the guy that makes the big decisions. He doesn't need to break out charts for any of us. We should be doing our own due diligence with the data that they provide to us, and come to their own conclusions. I don't know how he got forced into that. I'm assuming that person that recommended that got fired. I'm going to assume that they did. You leave that for like a little Fed president to do. He can break out the 10 charts that are 30 years away. Keep on pushing, don't stop now. Keep on pushing. Break on through to the other side, yeah. Yeah, this is going to get kind of neat up here. I'm really fascinated by whenever we come up into these. You know, this isn't like we're driving up here for the first time, right? This is coming up into some pretty well-known resistance. So normally I'd like to see, you know, some news to push us up there, but we're grinding. Got the algos saying, fuck you, we're going to push it up anyways. Yeah, my assumption here is, you know, I don't know what the trigger is. I don't know if the trigger is going to be Jerome Powell if they run it before, but whenever that squeeze happens, whenever we have that breakthrough, that March low, and can finally start to attack those January low or those January highs, excuse me. I'm saying March lows, but I mean March highs. When we start, like, do we get that nice explosive, just like straight 30 point, 70 point move, something like that? And when does it trigger? They've been really, what do they call it when they, when you, what do those people do? They have sex, but they don't come or something. Edging. I think it's called edging. Market's been edging us for, I don't know, a long time. Long time. Yeah. Soaking. I lived in Utah. Who just said that? Someone said soaking. That's some Utah shit right there. That's some Mormon stuff. We got a problem up here too. We have the attractor of 4600, but it also acts as a magnet, and then it acts as a repellent as we come into this 4,600. So we really need to break through that wall, and that wall degrade the gamma wall degrades for a little bit. We have some calls that drop off, or the gamma from those calls drop off on the 15th of the month. So if we can't break through it now, you should see a breakthrough, or at least an ungripping of the markets, even if we head to the downside. That's what's been holding this market up too. So there's an inverse relationship here, where the closer we get to the 15th, the market has more ability for even downside moves. Yeah, I gotta admit, I used to think Mormons were weird, and then I moved to Utah, and I have some really close to this day Mormon friends. There's like the culture I love, like the Jello stuff that they do, and they make great pies, and then the prepping and all that other cool stuff. But that is some verbiage from the soaking stuff, man. I remember that. That was the definitely the bad words for BYU students. Fucking get like you get Jello in Utah. It's like they just throw whatever they got in there. That like I wouldn't be surprised if I saw mixed vegetables thrown in a Jello mold. Canned mixed vegetables. Did anyone ever ask me to be a soaker? No. I never mess with any of that stuff. But it was funny to see. I couldn't do it. I don't know how. I always call it. This is pretty. I don't think this is offensive or anything, but I grew up Catholic. I'm agnostic now, or agnostic atheist now, but I was raised pretty heavily Catholic, and when I moved to Utah, I always felt as though Mormons were like Catholics that actually held their word. Catholics to me were like, oh, I can ask for forgiveness on Friday, receive communion on Sunday, and I'm good to go. Mormons actually do the things they say they're going to do. Although they, from my own experience, the things that they're allowed to do, they really go at excess into those things. So that's fascinating as well. If you're a Mormon out there, I love you guys. Yeah, Midwest dessert, right? Miss Talking Monkey say Midwest dessert. So I guess maybe that comes from the Midwest too. Jello with anything in it, doesn't matter what it is.
Protect your trades from macro headline risk with Financial Juice Pro. Now only $99 a year for our real-time service.
Yeah, they got all kinds of different things. It's weird. They have like it's okay to have butt sex, but it's not okay to have sex. They got soaking. They have this other thing where they rub on each other. It's really bizarre. Well, it's not bizarre. It's, you know what it is. It's a function of kids and adults and all that kind of stuff. It's like Footloose, man. It's just like Footloose. Tell someone they can't dance, they're gonna dance. Or tell a teenager they can't dance, right? Yeah, Jesus jammies, know all about those. Magic underwear, yep. Yeah, underwear, they are comfortable. If you've never seen them, they got stores. I forget what the name of the stores are where they sell them. There's like they got stores for missionaries for like young kids going on missions and stuff, places to buy your underwear. They're warm and they're comfy. They're very comfy. I have seen them at least. I have looked at them before. Yeah, Deseret. It's pronounced Deseret. Deseret Industries. Absolutely, that's what it is. They have a Deseret bookstore. That's kind of the place. It's where all the young Mormon missionaries go. It's funny too. Whenever I see them now, wherever I've lived, I've seen them, and they're always like they always usually or grew up wherever, very close to where I skied. So they're always shocked. I'll be like in downtown Detroit or something, and they'll be like, "You're from where?" I'm like, "Park City, baby, from PC." Oh hell yeah! You grew up in Sandy? Kid you not, man. I had hunted around. I'd spent some time hunting throughout my life, but never in my life had I been taught how to actually hunt like I was taught from a Mormon out in Utah. This guy taught me how to. This guy only ate meat that he hunted. He didn't or he didn't like go to a grocery store and buy meat. All the meat that he ate in his family and everything came from what he hunted. And it's funny is because I was like, yeah, I want to do the rifle hunt with you. So we went out to before the rifle hunt. He's like, no. He's like, we're not doing the rifle hunt. And I'm like, come on, man, let's do the rifle hunt. Big state, big plots. They give you like this big grid of where you can hunt and whatever. And I thought it would be the best time in the world. And it was a sea of orange. It was dangerous to be out there. And he was right. The rifle hunt sucked. And I wasn't a bow hunter. And he taught me how to bow hunt. Utah's a cool place that you can't leave out salt licks. There's a bunch of rules against. It's not like easy for a hunter in Utah. So when you go out during the bow hunt, it is dead quiet. It's difficult, and you're not given an easy way to track or even attract game. And this guy took me out in the woods for 3 years, I think. I want to say about 3 years. We bow hunted together, and it was epic. This guy knew everything. I would trust this guy with my life anywhere. This guy could go anywhere. I never hiked on a trail with this guy. We broke trail through all of our hunting. It was amazing. Yeah. We bagged that elk. We bagged a bull elk, and I got a story about that sometime. He got He's had 2 lottery tickets to hunt elk. Those are usually once in a lifetime tickets, and he's had 2, and it was wild. It blew my mind. Yeah, it was there. He killed. I was with him. He killed the elk with a bow. Pretty baller. Pretty fucking baller to kill an elk with a bow. Those things are scary up close. They're super scary. And they got grizzlies there. Where we live, they have grizzlies and cougars, mountain lions. It's dangerous. It's not as dangerous as Alaska, but it's pretty fucking close to Alaska. You have to deal with polar bears. Yeah, a drawn attack for elk is very, very rare. It's not for a bull elk is for most guys once in a lifetime. I got all kinds of stories about this guy. His wife, so he would process not only the game, the meat, but he would process the pelts, the shed horns. Like he would go shed horn hunting, and he would process the sheds and the whole animal, like tail or snout to tail, right? And he would lie to his wife about trying to process pelts in the family dryer, and it was so disgusting. It was so gross, and you could still smell it, but he would lie to his wife, and then he'd get caught. It was wild. This guy was like hardcore Mormon, hardcore. This guy was legit. Well, they got a tumble dry pelts. So you like cure pelts and like piss. I think it's piss and I don't know if it's lime or it's something else. I forget now. but you like coat the pelts in a bunch of stuff. You scrape them, then you dry them, and then you tumble dry them to soften them up. And it is a disgusting process. Back in the day, they used to use human piss for this, but I forget what they use nowadays. Yeah. Elk are some beautiful creatures, and they're dangerous. If they're in the rut, they will kill you. If you're like, I've been on trails sometimes and seen elks during the rut, half mile away from me, quarter mile, and I've been scared that they'll come run me down up into a tree. Oh, no kidding? Yeah. The Mormons do it right. I'll tell you what. If there was one state in the lower 48 that I would think would have it in the bag, if there was a way to survive anything, that's probably the state. I'd give Alaska, of course, probably the second place on that. And only the reason I would say second place in Alaska would be because there's a bunch of Utah people up there. But those guys are bred to do this stuff from a very young age, to prosper in those environments. Yeah, I'll do the dried storage. I did all that. I still do it, but not to the extent that I once did. I was just talking to my wife about it recently because I rebuilt everything but my food stores, and I've got the water storage, and I've got solar, and I've got generators, and I've got radio. I've got a ham radio and all that kind of stuff. But my food storage is not what it once was. And we were just talking. I was like, I got to break off like $1,000 and just buy. I need to like load up on a bunch of rice and beans and stuff. Dude, that Trader Podcast meme this morning was sick. He showed it to me on, I believe, Saturday or Friday. And I was like, I got to keep my lips shut about this. Like, I was like, I'm not going to tell anybody. And I was like, this is fucking pure gold. The song is what he didn't show me all of it. He just showed me the song. And I was in tears listening to the song. Like, in tears listening to that song on Saturday. I think it was Friday or Saturday night. He showed it to me, and he's like, I'm dropping it on Monday. And I'm like, dude, this thing is going to be insane. Oh, dude, he's here. Trader Podcast is here. I didn't see your post above, Trader Podcast. I thought it was fucking phenomenal, man. I was like, I gotta stay off the internet because I'm gonna blab to somebody. I didn't tell a single soul, man. That thing was awesome, by the way. I reposted it this morning, brother, on Twitter. That thing is awesome, bro. That might be my favorite song I've ever heard from Jerome. I thought it was great, brother. Absolutely fucking pimp. You saw what I DM'd you too, right? I told you how much I love that shit. It was banging, bro. Pure talent. And your buddy helped with the vocals too, right? So kudos to you and your buddy. Dude, seriously, give me this fucking squeeze. Give me this fucking squeeze, please. All right, I gotta go. I gotta get back to work. I'm in the middle of some shit. I'm trying to get the daily levels finished for the website. I gotta go. Bye. Here we go, gang. Almost there. Got a little bit more supply to the upside up here as well as we get up there. Got these two red bars up here. See if we can get a better viewpoint right here. Just keep your eyes on these two supply zones right up here, and then this third one right here. See him up there raining down some love there, right? See the rock throwers up here. They're just up here trying to sell down into in a big way. We'll see if this holds or not. They are trying right now.
stay up to date with the latest and be on the bleeding edge of news for non-farm payrolls? Then sign up today and get our special offer of Financial Juice Pro for a year's worth of our service for the price of 1 month and save 92%.
Yeah, I want. I asked Trader Podcast if he would do a meme for us, a JPOW meme for Wednesday. He asked me to come up with questions and record audio, and I don't know exactly what to do. Hold on one second. I got to answer a question.
Protect your trades from macro headline risk with Financial Juice Pro. Now only $99 a year for our real-time service.
I can't tell you guys. I cannot tell you guys. We've been sitting here now or I've been doing this bullshit for fucking days. And I'm just wanting that one giant green fucking bar, please. Give me that one green bar up one of these days. I don't care when it is.
want to stay up to date with the latest and be on the bleeding edge of news for non-farm payrolls? Then sign up today and get our special offer of Financial Juice Pro for a year's worth of our service for the price of 1 month and save 92%. Protect your trades from macro headline risk with Financial Juice Pro. Now only $99 a year for our real-time service.
We're back. Stocks starting off the week on a positive note with the major averages in the green right now. My next guest is betting that this year's rally will continue into year end and potentially all the way through 2025. Let's bring in Ed Yardeni of Yardeni Research. Welcome back. I mean, it's one thing to be bullish, but that's like off the charts bullish. Why so?
Well, I don't know that it's really off the charts. It's actually consistent with the underlying trend of earnings and the stock market for years. Every now and then we do get these recessions and corrections. We certainly had a bear market last year. It was a fairly conventional one with a 25% drop. Then we made a low in October of last year, and we're up substantially since then. We had a conventional correction during the summer. And now, since October 27th, we're back in what I think has been a bull market since the year before that. And I think the economy's proven to be resilient. I didn't buy the idea that it's going to fall into recession. It's been more of a rolling recession. But earnings are about to hit an all-time record high, and I think next year's economy is going to get a big boost from productivity. Everybody talks about AI and all the other technologies. They're all out there to increase productivity, and I think that's what's going to happen.
Yeah, I mean, I'm looking at your targets, right? 2024 year end is 5,400. 2025 year end, it seems hard to look out that far, but nonetheless, 6,000 on the S&P. I mean, so the implication here is that this isn't just a bull market. This is a new, very powerful bull market that we've started.
Well, I've been discussing the alternative scenarios for the decade since the beginning of the decade. In 2020, I said, look, it's either going to be a repeat of the great inflation of the 1970s, or it could very well be something more like the 1920s, the roaring 2020s. And I'm increasingly convinced that it's going to be the roaring 2020s with technological innovations solving the major economic problem we have right now is labor shortages, skilled labor shortages. Productivity, I think, is going to be growing 3.5% to 4.5% within the next couple of years, within this decade. And that may sound far-fetched, but that's the kind of peak you usually get in the productivity, the last 3 productivity booms we've had. So historically, it's possible. And I think this productivity boom that I see has more going for it in terms of the ability of technology to really apply to almost any business. I think any business these days is a technology company. They either make it or they use it. If they don't use it, they're going to be at a competitive disadvantage.
How many Fed cuts do you think we get next year?
Well, again, I'm not in the recession camp. I see there's still some what I call die-hard hardlanders out there that are still expecting recession. I don't think we're going to have a recession. In that case, I think the Fed is going to cut rates twice, not 4 times or more, which is what those who are looking for a recession expect. Look, I think the reason the Fed's going to be lowering interest rates next year isn't because of a recession. It's because inflation is going to continue to surprise everybody and come down substantially. We've been in the camp that has argued that inflation could turn out to be relatively transitory after all, and it's certainly come down a lot faster than has been widely anticipated.
What are you worried about, if anything? I mean, rising deficit, not even rising. I mean, it's like out of control, right?
Yeah.
Many would describe it as.
Sure.
The cost of funding that, messy election.
Right.
What, if anything, worries you?
Well, look, I pay close attention to the bears and the pessimists. They've done an outstanding job of telling us everything that can go wrong. Just they haven't been balanced and suggested what could go right. And yeah, I'm very concerned about the debt and the deficit. I was especially concerned this summer. I've been saying for a long time, I won't really care about debt and deficits until the bond market cares, and the bond market seemed to care. But you know, there's a saying, don't fight the Fed. I think on November 1st, we learned don't fight Janet Yellen at the Treasury. She cut back on the amount of bonds and notes and bond market like that. I think the bond market also liked that inflation's come down. So on the bearish side, you have profligate, out of control fiscal policy. On the bullish side for bonds, you've got inflation coming down substantially. I think we'll be down at a 2%, the Fed's 2% inflation rate target by the second half of the year. I think they were hoping they would get closer to it in 2025.
You said something powerful there, this notion of not fighting the Fed, because it cuts both ways, as you know,
Sure.
right?
Yep.
Are we in one of those environments again where we get a everything kind of rally because the Fed becomes more friend than foe?
I think that's partly right. I think what we're really seeing here is everybody's been characterizing the Fed's raising interest rates by 500 basis points as tightening, and certainly that there's a lot to be said for that. But I think it's also been normalizing. We're actually back to normal. We had a very abnormal environment between the great financial crisis and the great virus crisis. Now we're seeing interest rates back to where they should be, where the capital markets can actually properly allocate capital. So from that perspective, I think that we don't have to fight the Fed, because I think they're done raising interest rates. And now the big debate is how much they'll be lowering interest rates. But I'm arguing the economy can live just fine with interest rates where they are today.
Sure, but the other argument is what's yet to come from what the Fed's already done. And because what they've already done, we must be late cycle. That's the argument from bears. How would you respond to that?
Well, I mean, they've been making this argument for a while. I've been referring to their forecast as the Godot recession. It just refuses to show up. I'm not saying it can't show up. I'm not saying it's impossible to have a recession in 2024, but I think it's less and less likely. I've been arguing that we've been in a recession since the beginning of last year. It just happened to be a rolling recession. It certainly hit single-family housing. It certainly hit retailers. Now it's going to hit some areas of commercial real estate. But here we've got productivity at an all-time record high, showing signs of actually picking up in the second and third quarter. We've got construction employment at all-time record high. You've seen the charts on the construction of manufacturing facilities. It's just vertical, straight up. There's just so much that's going right that's offsetting what could possibly go wrong.
So over the late cycle's over. We've already rolled over. It was just rolling in that rollover, so to speak. And then now we have a new business cycle underway.
Well, I think that's the case. I think that we're getting out of a rolling recession environment, and now I think we're going to see 2024 as a rolling recovery environment. I think we'll find that housing starts to improve as interest rates go down. I think we're going to discover that commercial real estate is far more resilient and can withstand a rolling recession in old office buildings in downtowns. I think we're going to discover that the consumer has a lot of excess savings after all, and it's not just what they saved during the pandemic. Households have $150 trillion in net worth, all-time record high. Baby boomers happen to hold on to half of that, and a lot of them are retiring, and guess what they're doing? They're retiring, and they're spending all this money that they accumulated.
Ed, we'll talk to you soon. I always appreciate it. Thank you.
My pleasure.
That's Ed Yardeni. Up next, we're tracking the biggest movers as we head into the close. Christina Partsinevelos is back with that. Christina.
Well, investors not convinced about a new drug despite FDA approval, and cryptocurrencies taking a little breather today. We go over the numbers right after this break.
Doing the creepy crawly up the wally right now into the close.
We're about 17 minutes from the closing bell. Let's get back now to Christina Partsenevelos for the key stocks she's watching. Christina.
Well, I'm watching CRISPR Therapeutics. It's down about 7% despite the FDA approving one of its gene editing treatments for sickle cell anemia. Analysts are mixed on the approval, with TD Cowen downgrading CRISPR. They don't actually believe the treatment will be used broadly enough to support CRISPR's elevated valuation. We'll also have an exclusive interview with CRISPR CEO in less than an hour on Closing Bell Overtime. Switching gears, let's talk about cryptocurrencies taking a breather after their recent run on the notion that the SEC would approve a spot Bitcoin ETF. But today we're seeing Ethereum and Bitcoin down about 7%. You also have crypto brokers like Coinbase down about 6%, MicroStrategy almost 8% at the moment. Those names are some of the biggest areas of retail inflows just in the last few weeks. Marathon down almost 13%, Scott.
All right, Christina, thanks. Christina Partsenevelos. Up next, social stocks getting a boost today. We'll break down what's behind the move higher there for Pinterest and Snap. Just ahead, Closing Bell. Right back.
Can we get the tag? Can we get the tag, please? Give us the tag. Seriously, just hit it. Just touch it. You don't have to go over. You just have to touch it. I don't even care if you come back down. Just want to see that little tiny tick right there, please.
Want to give you a quick check on shares of Nike. Take a look. That stock is up today by 2.25%. Citi upgraded it to buy from neutral. They say the strategy for controlling costs should help Nike beat earnings estimates. Separately, Barclays also named Nike a best idea for 2024. Many positive notes on that stock of late. Up next, Oracle. The results are out in OT. We'll bring you a rundown of what to watch for when those numbers hit the tape. That and much more when we take you inside the market zone.
I'll tell you what, talk about being edged into this close. It's like watching, and like eyes are bleeding right now with the edging into this close.
Stay up to date with the latest and be on the bleeding edge of news for non-farm payrolls? Then sign up today and get our special offer of Financial Use Pro for a year's worth of our service for the price of 1 month and save 92%.
We're now in the closing bell market zone. CNBC senior markets commentator Mike Santoli here to break down the crucial moments of this trading day. Plus Julia Borston on what's sending Snap and Pinterest shares higher. Christina Partsinevelos joining us with the numbers to watch when Oracle earnings hit the tape in OT. Mike, I begin with you. A pivotal couple of days coming up, starting with CPI in the morning.
And
the street's pretty comfortable, it seems, with what might come. Some justified confidence that the disinflationary trend is pretty well entrenched. Probably get some confirmation tomorrow. And if not, there's been enough evidence that maybe you can write it off as a little bit of a fluky number. Very similar to Friday, where we just sort of chop around, do nothing in the morning, and then right after midday, just hop on the escalator for lack of a reason not to. I mean, I really couldn't find much else. Now, it is getting a little bit, again, just technically overbought. Just look at the rate of change stuff. We're clicking around the 20% year-to-date gain number in the S&P 500. And this is happening on a day when the very largest stocks are for sale, right? Because of this index reweighting in the NASDAQ. So all to the good. I think the only thing you would take issue with is, people getting a little bit too comfortable. Is it feeling as if we have it in the bag in terms of not just disinflation, but the Fed's kind of reaction playbook from there.
Let's see if Powell pushes back on that. I mean, that's probably the biggest risk of the week above and beyond a CPI, because we figure we know the trend of where inflation's going. Yeah. We're still not certain that Powell is our friend, so to speak, if you're a bull on this market.
And my take has always been that we're far enough out from any move whatsoever that it is much more about, does that act as an excuse because we got positioning a little bit, on one side of the boat, and we're going to have to correct that a little bit. We over-anticipated a cut. Also, just yields in general have a little lift to them right now. So see if that makes any kind of a difference. But I don't think that the story will go, the economy's fine, but hawkish words from the Fed chair, and therefore a cut farther out in the future than expected is going to somehow be the thing that brings on the big one, anything more than a modest pullback.
Yeah, we'll see where the so-called dot plot lies, and we get an outlook, so we'll have a better handle on how members of the Fed see the road ahead, at least from their own projections. Julia Borston, so I got Snap up 4%, Pinterest is up about 1.5%. What's happening?
Well, we have those big movers in social media. Snap shares soaring about 5% after Wells Fargo upgraded Snap to outperform with 46% upside in its price target. The company also raising its 2024 and 2025 revenue expectations, saying the company is poised for positive growth as its investment in direct response advertising pays off. Meanwhile, Pinterest shares are up about 2%, 1.5% after RBC upgraded the stock on its.
That's right, you dirty skanky price. Dude, get up there. Like, what are you doing?
Also, its partnership with
Creepy crawly up the wall. Let's go.
New products as well as ad supply. Bank of America also
like 6 minutes left.
Top mid-cap pick. They also cited the impact of that Amazon deal. Meanwhile, Meta is BofA's top large cap pick. And for all of these companies, Snap, Pins, and Meta, the growth in direct response ads, the ability to directly drive sales has been key to their growth. Scott?
Yeah, the other stock I know you're watching is Netflix, which we are today because Rafa and Alcaraz are going to have a little tennis match on Netflix, see.
That's right. Netflix announcing the Netflix Slam. This is just its second live sports event ever, and its fourth ever live streamed event. It's a one-night tennis match between Rafael Nadal and Carlos Alcaraz. It's set for March 3rd in Las Vegas, and they say additional players and matchups will be announced later. Now, this news comes after last month Netflix hosted the Netflix Cup, a tournament with athletes from two of its popular sports documentaries, Drive to Survive, in full swing. Now, Amazon, Google, all the media companies have been investing in media rights, and they come up rarely, but Netflix is taking a totally different tactic, creating their own sporting events. Scott?
All right, Julia Borston, interesting news there. Christina Partsenevelos, Oracle shares are higher heading into the print in OT. What do we expect today?
There's a lot of focus on Oracle's cloud infrastructure business, which is its public cloud business. It remains one of the most important metrics this earnings season. Morgan Stanley's Keith Weiss says that segment needs to reach about 60 to 65% year-over-year growth to actually hit similar levels as of last year. Investors will be looking specifically if cloud demand recovers after the big miss last quarter, aka it's called the OCI business, so just look out for that. Oracle's Cerner business, which provides health information technology, is also expected to continue to remain weak and weigh on licensing revenue. The AI backlog, though, should move higher from about $4 billion last quarter to roughly $4.5 to $5 billion this quarter, especially considering Oracle actually has greater GPU availability given its strong partnership with NVIDIA. And so those chips help Oracle make inroads.
That's right, you dirty dog. Get up there and slam it. Touch it. Please, just touch it. It's making my eyes bleed, baby. Just do it.
Was pretty
do
bad,
it.
and that
Touch
lowered
it.
But that's setting
Slap
the stock
it.
up for a rebound this quarter, possibly. Morgan Stanley even titled their latest analyst note on Oracle, "Playing for the bounce back." Scott.
All right, Christina, we will see what happens in overtime. Christina Partsinevelos, thanks for everything today. Mike, that stock's had a great year.
Yeah,
it's up 40,
I was going to
40%.
say, bounce back from a 40% year-to-date return. It's at about a 20-year high in terms of valuation, about 20 times earnings. And this will be a test as to whether the market really wants to further revalue this company based on the AI.
Oh boy. That's what you were looking for. That's super bullish. I don't know if you know that, but the only pivot left to take out is truly the high from January of 2022. Congratulations, bulls. Very bullish.
If you can, change the stripes midway.
So you'll be watching yields obviously closely over the next 48 hours. Considering where they were at the last Fed meeting compared to where they are now, the 10-year's at 423.
I should be playing some music right now because if you're a bull, this is big for you. Congratulations.
Seems to me that
you've taken out all of the March 2022 highs. You are now just looking for Valhalla, baby. You got one more pivot between, well, you got some volatility to get there, but you've got one more real true pivot from January 2022 to attack now. Congratulations.
Until 2025 or 6. All of that put together, it says they're in no hurry. They think policy's in a good spot, and I don't really even think the Fed is the crucial thing at this point. It really is, does the economy continue to chug away such that
you could end up seeing a big rejection up here or really big moves to the upside. They could front run this in a big way. So this is big news, though. You're not quite that you still have to beat the January 2022 lows, but this tag above the March highs of 2022 is significant for bulls. It does mean something. You are going to see news come out about this at some point today. You'll see people, chartists specifically, will be out there focused on what's happening right now. It's very big, very bullish. Not necessarily in the today or tomorrow, but for the market in general. Congratulations, bulls, that have been stuck since fucking January, or at least March of 2022. There's probably a bunch of those people trying to get out right now. So just note that this is a very notable place in the stock market. Congratulations if you're one of those people.
Intraday highs for the year for the S&P 500 and the Dow Industrials as stocks continue the year-end rally. That is the scorecard on Wall Street, but the action's just getting started. Welcome to Closing Bell Overtime. I'm Morgan Brennan with John Fort.
And coming up on today's show, we're going to speak exclusively to the CEO of CRISPR Therapeutics following the FDA's first-of-its-kind approval.
Yeah, all these mechanics have nothing to do with CPI. They have to do with these algorithms that need to tag these numbers. Like this was an algorithmic move right here. The entire move up to here was this previous high from 2022. Sorry, apologize, but the algorithms, the market doesn't care about CPI prints right now. They care about tagging these previous highs, previous pivot points. This is big. Big congratulations, bulls. Congratulations. You got one more left, bull. If you're a bull out there, well, you've got some. So from this point forward, right, if you're looking for your upper pivots, for the upside, you've got some stuff to be looking at. 465.16 And then you've got a 471.34, 476.71, and then the big boy up there, 480. The door is open now. Does it mean we go there right now? Probably not. But what it does mean is that the door has been kicked open. If you're a bear or a bull, the door is wide open to those January highs from 2022. So congratulations, you've tagged you've opened the first door to your last BB. What is it, big bad guy? Your last BBG of the highs from 2022. Congrats, Bulls. We've been waiting a long time for this one. Y'all been waiting how long now? Almost 2 full years, right? Almost 2 full years. Well, I guess March would be a year and 9 months or so, 8 months, possibly a year and 8 months. Bulls been waiting to get back here. Congratulations, Bulls.